Hello, and welcome to the May 5th, 2026 meeting of the Governmental Accounting Standards Board. Great to see everybody, have you here in Norwalk. Really looking forward to a productive day. Lots of good discussions on TAP. But first, we have to approve the minutes from our March 25th, 26 board meeting. If there's no discussion on the minutes, may I have a motion to approve them?
So moved.
Thanks, Diane.
Second.
Thanks, Robert. All in favor, say aye.
Aye.
Any opposed? Hearing none, minutes are approved, and we can move to our first technical topic, which is revenue and expense recognition. Pam, turn it over to you to walk us through what you have for us today.
Thank you. Good morning, everyone. So we're going to start off our discussion this morning with a discussion about the allocation of consideration. And so we're going to start with paper one, and I'll be taking you through that paper. At your February 2026 meeting, you made tentative decisions regarding objectives for the allocation of consideration related to two different aspects. First, allocating the total binding arrangement amount to each transaction. And secondly, allocating the total category A transaction amount to each performance obligation. So the purpose of this first paper is to address the methodology for those allocations. At that February meeting, you tentatively decided that the objective for allocating the consideration, including in a binding arrangement, is to allocate consideration in a manner that provides a faithful representation of the economic activity in each transaction. And so we looked at, in the paper, first started by looking at Statement 87, in which the board established guidance for allocating consideration in contracts that include multiple transactions, such as a lease and a non-lease. And in that statement, the board provided that you should use prices included in the contract to allocate consideration to each transaction, provided that those prices do not appear unreasonable based on the terms of the contract and professional judgment, maximizing the use of observable information. Then in circumstances when contract prices are not observable or appear to be unreasonable, Statement 87 requires governments to use their best estimate to allocate the contract price to each transaction while also maximizing the use of observable information. Hang on a sec. So FASB topic 606 also has a similar, obviously, issue regarding allocation. And in that guidance, it establishes a methodology for allocating the transaction price to performance obligations using standalone selling prices, which it defines as the price at which an entity would sell a promised good or service separately to a customer. It also emphasizes the use of observable information such that if a standalone selling price is directly observable, the transaction price is allocated on a relative standalone selling price basis. When standalone selling prices are not observable, entities would estimate those prices using methods that maximize observable inputs. So as you can see, both Statement 87 and Topic 606 rely on observable information to support the allocation. The project staff believes that using observable amounts specified in the binding arrangement to allocate the binding arrangement amount to transactions closely aligns with the project's categorization methodology. This is because to determine whether a transaction is a category A or category B, a government assesses whether the binding arrangement includes substantive rights and substantive obligations for each party, and whether those rights and obligations are interdependent. That assessment is based on the provisions of the binding arrangement because those provisions would align with the intent of the parties in defining the nature of the rights conveyed and the obligations incurred by each party, which informs the nature of the economic activity, which is the transaction. Therefore, we believe that the binding arrangement provides the most relevant observable evidence of the economic activity in each transaction, And using observable amounts in the binding arrangement as the basis for that allocation helps align the allocation of consideration with the same economic activity that underlies the identification and categorization of transactions. Project staff believes that a rationale similar to Lisa's could apply in the context of this project by permitting governments to rely on observable transaction amounts stated in the binding arrangement when those amounts do not appear to be unreasonable. Although the rationale may be similar to Statement 87, it's important to point out that the assessment in this project may differ from that made under Statement 87 regarding the judgment of whether the amounts stated in the binding arrangement do not appear to be unreasonable. This is because under Statement 87, observed amounts in the binding arrangement that are significantly different than other similar transactions, for example, a nominal or zero amount of consideration for one transaction, may indicate that the stated prices do not faithfully depict the economic activities and therefore may appear unreasonable. In contrast, in this project, such circumstances may faithfully represent the economic activity in a Category B transaction and therefore may be reasonable. And we provided an example of this type of scenario in the paper. The project staff believes that in circumstances in which the binding arrangement does not specify observable amounts for individual transactions, or those observable amounts appear to be unreasonable, using an allocation methodology based on estimates may be necessary. In other words, the relative amount of consideration attributable to each transaction would be estimated based on inputs such as the cost of providing the services or standalone selling prices. This would allow governments to have the flexibility to select a method for allocating that is based on the facts and circumstances of the binding arrangement, provided that the method does not override the categorization of the transaction. The project staff believes that the application of a common principle in developing an estimation methodology that is maximizing the use of observable amounts in that allocation helps to provide comparability. Before I pose the first board question, I'll just note that task force members who provided feedback generally agreed with all of the project staff recommendations in this paper. So board discussion question number 1. Does the board believe that to allocate consideration from the total binding arrangement amount to each transaction within the binding arrangement, a government should use observable amounts relative to each transaction in the binding arrangement, as long as the amounts do not appear to be unreasonable based on the terms of the binding arrangement and professional judgment? And the project staff recommends this.
Thank you, Pam. So I thought about this one a lot, and I kind of wrestled with it, and I really was trying to put myself in the shoes of a preparer predominantly, and thinking about this kind of holistically within this project and how this plays out, how a preparer, a stakeholder might react to doing this. And the thing that I kept worrying about initially was this idea of what makes something unreasonable. And like if you used your example of two cities contracting with each other, kind of one part of the agreement is I'm going to provide E911 services in exchange for cash, and the other part of the agreement was we're going to donate this storage facility or maintenance facility. And one of them is a donation, so it's Cat B. The other one is not, so it's Cat A. But what makes that reasonable? Like, what is it that if I'm a preparer, I might think it's not reasonable to donate a $1 million facility to another city. That's really just all part of the same consideration. It should be all meshed together. That would be more reasonable. And I think governments do things for different reasons, right? They don't always do things for pure economic benefit. And so I get why we would need to kind of deal with and break apart these transactions and look at what governments write in agreements. But in agreements, governments sometimes write strange things. And so we do have to have some way of pushing these out. But when I step back and look at it, so all that led me to what I worry about is stakeholders. We've taken fair value, equal value out of this, all of this project essentially on purpose. And I worry that most of them will come back and they think reasonableness, they're going to think about fair value, equal value. That would make something reasonable. And so then I stepped back and I said, well, in a situation where you have A's and B's in the same contract, it kind of seems like this is driving at a step in measurement, right? You know, I've got this amount, I've got to allocate it in order to measure my amounts. You have to kind of do this in categorization. And categorization, we have to identify the substantive rights and obligations to identify whether they're interdependent. And the substantiveness of it is, you know, is there something substantive there or not? In other words, if I'm donating or selling a building for $10, yeah, there's something there, it's something for something, but it's not substantive. So in a Cat B, theoretically, it kind of shouldn't have anything assigned to it from the consideration, because that's what makes it, there wasn't something substantive there for consideration. And so I just worry that this step is kind of already inherently being done in categorization, and that's where it belongs. And I get that maybe we need to add some words in categorization to bring this idea out, potentially. But I think one of the most important words is management's intent. Like, what was their intent in writing this contract or in entering into this agreement arrangement? Was the intent to donate the building on one side and to do, you know, to exchange cash for providing E911 services on the other side? And so I think there's a way to bring intent and the separation of the amounts within categorization without bringing, number one, reasonableness or unreasonableness into it. And with it not, I don't know that you intended this to be part of measurement, but it kind of seems like it, maybe because where we are on the project, but really to write those words in the categorization part. And so I don't know if other people feel that way or what, but that was, are my thoughts, I guess, on this question.
Can I just,
Please, Pam.
and we talked about this a little bit prior to the meeting. And I think that, you know, as I mentioned in my presentation of the paper, the intersection of this with categorization is really important and is very tied to each other. And so I think that Joel makes a really good point in terms of not leading people towards this thinking about equal value, because that's an important part of the project that we've worked through a lot. And so it is very similar. I think that in many cases, you know, as you're looking at a binding arrangement and trying to work through how to, whether it has a performance obligation or whether it does not, you're going to look at very much the same things that you would be potentially looking at as we've described this allocation piece. And so I agree that you could, you know, tweak the categorization provisions to include this intent and this idea of the allocation, to make it all meld together and not be a separate kind of piece of measurement, where it really, you know, makes sense that it could be part of categorization. So interested to hear what everyone else thinks.
Thanks, Pam. Chris.
So one, I agree with the staff recommendation. Two, before getting to Joel's point, so it's kind of minor, but I thought it was major in the, and I had a chance to talk to Pam a little bit about it, but the terminology, even though it's similar terminology than what we used before, I just find it a little bit confusing, or it could be confusing to people who are trying to interpret, and not unreasonable versus reasonable. We're not talking about probabilities where there's more likely than not, and, you know, 5 different, you know, places to go along a spectrum. It's literally a heads or tails. either you're reasonable or you're not reasonable. It's not more reasonable than not slid in the middle, where it's covering some geography there. So one, I think that just in the explanation of the allocation, it should just be if the allocation is reasonable. And I don't want to get too far into it, but I think part of it, and Joel, maybe what I focused on was professional judgment there, and understand. I wrote in the paper, whether it's right or wrong, they're going to be different determinations made by different people based on the facts and circumstances, because professionals are different and people interpret differently, right? And so you can have two people do a receivable reserve and come up with two different numbers based on two different estimation processes. And it doesn't make either wrong, and it doesn't necessarily make either right, but you need to understand, kick the tires, and see how reasonable it is. That all said, I think what Joel says makes a lot of sense to me, but I guess I just need more time to digest. To me, it's very similar to earlier on in this process, when we first started that categorization, right? How many different measures did we have on categorization to get to it, right? We had like 5 steps, 6, 7 steps. And then we went through a process and said, we don't need all of those steps, because when we look at it, this is inherent in this, and this is inherent in this. Right now, where I'm at is that I like the idea of my food not touching, right? I like the idea of I'm going to attack categorization and determine if there's a performance obligation here. And then after I do that, I set that aside, and then now I'm going to move on, and I'm going to reorient my mind to allocation, and I'm going to allocate based on that other stuff that I just did over here. So both make sense to me. I'm more comfortable with the latter because, it's new to me, and that's kind of helping me along the path. But that doesn't mean that, your way, your suggestion doesn't make sense. It's just trying to determine if it's just me, or if that's in the greater good interest, or if others who are going to be new to this need that extra step to figure it out, or they don't, right? And we're babying people too much, and they can just figure it out and they'll get it. And I just don't know that yet, but what you're saying makes a lot of sense.
Diane, thanks, Chris.
So I agreed with the staff recommendation. I liked the consistency with statement 87 and topic 606, but I really liked Joel's suggestion, and I had not considered it that way. It's kind of like what Chris said about, as we've gone through this process, we've kind of rolled things together. And to me, what Joel's described has kind of felt like that, okay, we're going to roll it together up at a higher level when we get to the categorization, so that there's so many different pieces in the whole measurement. And we've had to deal with all of these, taking the onion piece by piece, or layer by layer off. And if we can simplify part of this, I think that's a really good thing. And what I'm hearing, and I'd like to see a little bit more about what Joel has described, but to me, it sounds more simplification at the measurement level and maybe just rolling it in at that categorization level. So I like the concept.
Thanks, Diane. Robert.
I also agree with the staff recommendation. I was going to echo Diane's comments about the consistency with 87. Joel, what you're bringing up is something I didn't even think about, so I appreciate that. I think it makes sense to explore it further. And then Chris's comments about reasonable, or when I was providing comments to the staff, I was getting in the double negative thing. Can't we just get rid of the double negative and say if it appears reasonable, that it doesn't appear unreasonable? It might simplify things, and I think that was a key word in one of the paragraphs in the paper, was simplify, because this is going to be a complex area for preparers to wrap their arms around, and so anywhere that we can simplify things, I think, is important.
I would just highlight, I understand the comparison and use with the statement 87, but statement 87 on leases, they're all by definition exchange. There are no non-exchange transactions included there. And so it may make, like, for example, we get to question 3 and you're dealing with all Cat A transactions. I'm not as against using the same terminology and that same logic. It's just when you try to mush Cat B and Cat A together, now all of a sudden, I can't totally follow the same logic because it doesn't always apply that same way. So,
But you're talking when you've got a situation like the example that was outlined in the paper where you've got two transactions within the same binary arrangement.
correct.
Right.
And that's the
So-
whole, that's the, like a lot of categorization when we were first thinking about it, we were looking at a transaction. Does this transaction have substantive rights and obligations? And so this is, okay, within that, sometimes in our definition of transactions that it's evidenced by one or more binding arrangements. This is as part of that, and a little bit, this is kind of what I was letting other people talk for a bit, but my reaction to Chris was, I think they're going to do it, they have to do it already in order to get the economic activity identified and to separate within this contract that I have two different or multiple sets of economic activity, each of which represents a transaction. I already have to understand which one has substantive obligations and rights attached to it, which means I've got to apply consideration or not apply consideration to it. So I've kind of already, I have to do it then. And so separating it out in a piecemeal way later, it was what worried me, I guess. But, you know, I think, well, let's see what other people say too, but I do think some of this is, it needs to be fleshed out more a little bit, right? We're not going to like fully decide on it today on this idea, but if you're open to it, maybe we could see if the team would put something together that would flesh it out more if people are open to exploring the option as opposed to this exact recommendation. Jeff.
So my initial thought is that, you know, I've been pretty trained over time to think sequentially, that there's categorization, there's recognition, and there's measurement. And the measurement's the caboose of the train, right? And that's what you do. And now what Joel, you seem to be suggesting is let's put the caboose up to the front of the train. And let's do it for just these certain types of mixed transactions, maybe Cat A, Cat B. And so I start to think, again, as initial reactions here, is that's what is that going to do for all the other ones that aren't like that? And we're going to now have this measurement be part of categorization, right? So I'm wondering if there's some acknowledgement, like when I was talking to Pam, I think this is related to that thing I brought up to the staff when I talked to them. I said, because they talk about it in the paper, they said this allows governments to have the flexibility to select a method for allocating that is reasonable, provided the method doesn't override the categorization. Right? I said to Pam, how could that happen, right? Like, how could you do this and override categorization? And I guess what yours, maybe and the transaction pointed out was this category A, category B mix thing. And so maybe that could happen. And so I'm wondering if there's something where we don't fully send it up to categorization, right? But we tie it in a way that if for these types of transactions, the categorization decisions that you made will be how your allocation will happen, rather than, because again, it's not fleshed out. So I only can think of like, oh, we're going to carve out these A-B transactions and have a whole section that talks about categorization and allocation together. And then everything else works differently. And I'm like, that's confusing. You know, why are we doing it that way when we could just, if there's a way we could create that effective link between in these transactions, there's categorization, and remember the categorization decision you made, and that's going to drive your allocation decision when you get to it, right? To do that for these guys in a way that you may not have to do it for the other types of transactions. So that's my initial thought.
Yeah, I guess a couple of reactions. One is, you know, we like to think of it linearly, but in effect, people are doing it all mushed together kind of at one time a little bit. And especially if you think I go to categorization, recognition, and measurement in order to determine what to recognize or when to recognize it, I have to know what it is. So I have to know, is it an A or a B? And so I've already had to, within categorization, separate out these things. And how do I separate them out? I separate them out based on, are there substantive rights and obligations? So I've already kind of, to me, I've already done what this step is asking us to do. But, and maybe that's a little bit what you're talking about and trying to tie it back.
Right.
Because once you get down to measurement, I do have some consideration that I have to allocate, but it's probably going to be in the A's, and it's going to be like question 3, as opposed to going back up to categorization and now kind of rethinking about the thing I already thought about. But
there might be some allocation. Well, maybe not. I mean, I guess I was going to say with the B's, there's something there. You have to figure out what the it is, right?
I've thought a lot about the B's and whether there could be multiple B's or whatever. And I really can't come up with an example of one in my mind, except potentially pilots. And pilots are their own kind of weird thing that I think we're still going to have a paper on. They're a unique beast, but other than pilots, I just don't see that really happening a lot, other than donations, like the examples that we have here, right? Jackie.
So I was thinking a little bit like Jeff and Chris, that either my food doesn't touch or I think in a line, even though it does happen all at the same time, as Joel is saying, we still think about it a little bit in an order fashion. And I guess I was thinking I can define a cat A and cat B and having a substantive right and obligation without actually assigning it a dollar amount. I can kind of look at it and say, this is important. It's a big deal without having to allocate a dollar amount to it necessarily. So while I see it all happening when we're looking at the contract, which I know you don't like that term, but that's kind of what we're looking at, and making the allocation decision there, the categorization, the recognition, and then allocation eventually, or the measurement. I can see what you're saying too, Joel. You're cramming it all into one space, so it gets kind of muddled, even though those of us that are looking at it are going, yeah, but we're still all thinking about it linearly. So maybe it does need a little bit more time to look at, but I agreed with the staff recommendation on this, that basically it's going to be a judgment decision in the end on how the allocation is made and what happens with the process. So I agreed with the staff recommendation on going forward, but maybe we do need to provide a little more guidance on how this would actually occur. It could be a little bit muddled, but even if you look at 606, it's all a step sequential process. You look at it this, and this. And I think that you're going to have to do that with a cat A and a cat B too. You're going to have to make that decision first.
And I think there's a point in there that strikes me that maybe Joel's a little ahead of the game, right? Yes, maybe in real life it'll be done all at the same time, but how is it going to be understood before you get to the point of actually doing it? And yes, you'll recognize and do it all. It'll be understood maybe more sequentially, right? And if it's explained muddled, mashed together, that may be harder to understand than if it's explained sequentially and somehow addressed that these are tied together. That's the only thing that I think about with that.
So this all started for me really butting up against the word reasonable or unreasonable, and the concern that connotates for most people that aren't steeped in our thinking an equal value, a value notion, right? Like was it reasonable to donate that shed? Or if I didn't put the word donate in my contract and I just had, I'm going to provide this maintenance facility to you and we're going to have E911 services. Now, management intended for it to be a donation. They kind of started both processes separately. They were going to donate this facility because they were, for some of the reason, they wanted to contract, and they said, we're just going to put it all in one contract. And so that was their intent, but they didn't write the word donate in it. And so if I read the binding arrangement, is it reasonable that the shed was really kind of part of the compensation for the E911 services too? Or how do I know it was a donation? And I guess I think management's intent comes in. And so if we need to keep the word reasonable, if we need to keep it as a separate step, I guess at minimum, we need to at least explain what reasonable is and that it isn't equal value. It's still based on intent. It's still based on these categorization principles of something for something or not. And as I tried to wrap my brain around that and trying to explain what the word reasonable is, I was like, why do we even need it? Why aren't we really already doing it up here? And that's kind of how I came around to what I talked about. But I don't know if people have reactions to that. We haven't heard from Carolyn at all yet. Carolyn.
I agree with the staff recommendation. I like this sequential approach. To Joe's point, because I have been steeped in this for a couple of years now, I didn't automatically associate reasonableness to fair value, but I can see how a large population of our governments probably could. So I do think that's a conversation that we need to have. And I'm open to digging further, into Joe's suggestion or into other suggestions. But right now, and my response back to staff was I did agree with their recommendation. And if we do proceed to move forward with that, I'm fine with that also.
Thanks, Carolyn. Jeff.
I think it's also true, Joel, I guess in your scenario, or one of the things you may be struggling with is if in that storage shed example, because you gave the example, like what if the shed is thrown in there for $10 or some minimal amount, and then the government thinks, well, wait, maybe that's not a category B, that's an unreasonable category A, right? Is that what you're worried about? Like that's just an unreasonably priced category A instead of.
It's a version of it. Like it's a way in which my concern could manifest. Yeah.
Yeah.
I think part of it, Jeff, was you're getting measurement and you'd already had to decide before you ever got to measurement, do you have an A or a B? And when you decide we have an A or B, was it more about what management intended to do than about the price they put on it?
Right.
Right. And so in my mind, if you take the word donate out of the example, right? It's just, you have these two things. How would you know whether or not the consideration was the shed and the money for the services, just one A, or how would you know it's two Bs? Well, you'd have to talk to management. You'd have to figure out what their intent was. Their intent would inform the fact that no, that was really a donation and performance obligation. You already know that by the time you get here, right? And so then, even if it was $10, you wouldn't get to that was $10 as an A. So you already know what the intent was. So I kept thinking about what if the word donation wasn't in the example.
It's sort of like what I was talking about. Like you go back to, Forza, stick with your categorization decision, right? Do not alter your categorization decision as a result of doing this allocation thing, and rather than necessarily bringing it up to categorization. That's at least how I'm thinking about it. And by the way, I agree with the recommendation of question 1. So.
I ask a question because maybe I'll ask what you're about to ask. Are we agreeing with the recommendation in the sense that whether staff recommended is we're done, or are we agreeing that we have the recommendation, but the idea that Joel's put forward, in other words, we need to come back and I'm not sure what the right word is, put some words around it, put some more thought around this notion that Joel's advanced. Are agreeing with those two things together, or is just we're agreeing with the paper as it stands and that's what we agreed to?
Yes,
I don't know. I'm not clear on that. I don't know if you are.
That was what I was just going to say. I'm a little fuzzy on that as well. What Alan said was right, is whether we're good with what the recommendation is as written and moving on, or whether we need to potentially come back with some version to consider related to combining, some of the idea of intent into that, combining those two ideas together in some way. Because
Pam, it'd be fair that, like, from our standpoint, having talked about this, we see some benefits and value to bringing that conversation back and have that conversation, right?
Yes, we do.
Jackie, then Chris.
I agree with the staff recommendation. However, based on what Joel said and what you said, Pam, that there might be some value in looking at it a little deeper. I'm still agreeing with staff recommendation, but I would like to know what you think about it to see whether I want to change what I'm agreeing with right now.
Thanks, Jack. Chris?
Yeah, everything that Jackie said, and then added in that little pinch of, can we get rid of not unreasonable? And that would work, right? It's reasonable, but then the second level when you're discussing is to the extent that the allocation is not reasonable, right? Or unreasonable, right? Then you go on. So you still get your reasonable and your unreasonable, but you start with reasonable. And then if the allocation is deemed not reasonable, then you move on to the other steps that we talk about later in the paper.
Just don't like that double.
I don't like the double negative.
I guess can we, I don't want to presuppose question 3 because in my version, question 1, reasonable goes away, but we'll see where that goes. But question 3, at least I see value in reasonable or unreasonable staying there. So this concern is going to come back up. And so I don't know if we just, as a phrase, if the board wants to weigh in on that phrase, whether you're okay in either question, either or, not, whatever it is, not unreasonable or reasonable. Can we just talk about that specifically if people have a vote? Diane?
I'm with Chris. I don't like the double negative at all. So I would definitely go for reasonable or unreasonable and quit this not unreasonable stuff. Also, in addressing Joel's suggestion, in my mind, it's like, okay, we're going to go 2 tracks. We're going to continue down the road that we're on, but we'd like to explore this and having staff come back and give us kind of an analysis of it. And then that way, maybe we'll converge and decide to go back and remove some of this or combine it. But that's kind of how I see it.
Thanks, Diane. Robert?
I think as it was going around the table, I'm now in Diane's camp, which I think was cumulative of what Jackie and Chris had said. I get rid of the double negative. But I keep going back to this. Are preparers going to look reasonable and they're going to equate this fair value thing? And so somehow in there, I think there needs, and if that's what we're asking the staff to go back and give some consideration, bad word, but give, not intentionally, to some thought into how we better define that to ensure that we don't run into that issue, then that I'm good with that.
Thanks, Robert. So before we go too far on I appreciate that, on the not unreasonable, I was persuaded the other way by our experience before in 87, where the ED or PV or whichever one it was said reasonable, and all the stakeholders said, now we're going to have to prove what's reasonable. Right. That what was stated in my exchange or exchange transaction was reasonable. And so the board said, well, we don't really want you to have to prove it every time. But if it looks really weird, if you step back and use judgment and it looks really weird, then maybe you've got to think about other observable inputs. Otherwise, just rely on what's in there. I was persuaded that not that long ago, we heard that. And I worry we're just going to hear the same thing. And so I was persuaded, even though it is, I understand why people want to get rid of it because it's way more direct to say reasonable. But to me, there is a difference between something being reasonable and something not being unreasonable, at least in the context of what we're talking about. And so I was, with that part of it, wherever reasonable or unreasonable stays, I was okay with it staying that way for that reason.
Hey, Joel,
Yes,
if that's the case, can you help me understand it? Because I don't see I wasn't here when we did that. But to me, I see that we gave a different term that accomplished the exact same thing and said the exact same thing, and people were more okay with it and they digest it. So what is the difference there?
Go ahead.
Chris, I think about it this way. I think about it. If you say it's reasonable, I haven't started with a basis that it is something. Now I gotta explain to you it's reasonable. If If you say it's not unreasonable, I start with it's reasonable. Like it's already, I don't want to use the word assumed. It's already thought to be reasonable. So now I don't have to do anything to be there. I'm already there. It's kind of like mutual assent's already assumed in a binding arrangement. We didn't have to prove it. It's just assumed to be there. So I think when we say not deemed to be unreasonable, we're allowing for the assumption to be it already is reasonable. So therefore I don't have to prove it. And I think that's why they went the place they went in 87 to not having to prove it. So while they seem very different, it's where I start from. Do I start from I don't have any foundational belief, I have to prove my belief, or I start from it is reasonable, prove it's not. I think that's how people interpret the two different phrases.
So I get the theoretical idea of it, but again, in order for me to say that something is, in order for me to come with that assumption, it's the trust but verify, right? Like I'm not going to just assume the reasonableness of something that's said and then say, okay, is it less? There's still a certain amount of work, at least from my perspective, that would go in if I'm the auditor or if I'm the preparer that will be audited, that I have to go in to get to a certain level before I'm comfortable either way with that, whatever the terminology. I get the argument, but I don't understand how that works in practice. I feel like I'm doing the same amount of work.
And this is just my personal thought, and I could be wrong on this, but I think the idea was it's easier to see and know when something's unreasonable than to know when something's reasonable. It's just easier. In other words, that $10 example that Jeff, you know the unreasonable when you see it a lot quicker than you know the reason, because where is that reasonable bar? Could be almost anywhere. Whereas the unreasonable bar, you look at that and you look at the contract and you look at the binding arrangement, you look at the numbers and go, yep, that doesn't pass a smell test. So to me, the unreasonable thing was almost, does it pass a smell test? No. Okay, I'm there. Rather than where's the bar?
To show something's not unreasonable, you can use professional judgment. To show something is reasonable, I've got to prove it. There's not just judgment. I've got to have evidence.
See, and maybe that's where I'm getting, because for me, to prove that something's reasonable, I can use professional judgment. If I sit down and I talk to you about a contract and you tell me as the CFO or the county executive director, whatever, that this is what into the thought process, I say, okay, that makes sense. I kick the tires on it. I'm moving on. So that's reasonable to me in the same way that I would go about determining if it was unreasonable. So for me, in my head, it's kind of like, again, it's like two sides of a coin. So I can't figure out what that space is in between. And that's what I struggle with.
I understand that, but at least with 87, our stakeholders told us that was a difference that they saw. Right or wrong, I guess, but that's what they told us. Kira.
Getting back to the question that was asked, I was fine with the staff recommendation, but like others have said, I'm also open to see what additional information can be brought back for our consideration at a later date. Regarding the reasonable and what was the term, not unreasonable, I was fine with that too. I understood relying on the professional judgment to determine if, something was not unreasonable and not having to show that it was reasonable. So from my perspective, I'm fine with that language.
Thanks, Carolyn. Jeff?
So Joel, when you were making the suggestion before, you said you were suggesting taking the reasonableness term out entirely, whether it's not unreasonable or reasonable, whatever, taking it out entirely. So you would be okay with Q1 being just observable amounts, period? Is that what you're saying in effect? Like that's where I'm going. I'm saying observable amounts, period.
No, I think,
that are in the
well, that's why
in the binding arrangement.
in my world, we kind of scrapped this whole thing in a way, and it comes up into categorization and something different. I think it has to be, that we have to separate the binding arrangement to its contracts based on management's intent and the economic activity of the various economic activities within the binding arrangement that represent different binding arrangements, using management's intent to separate those. And in doing that, and determining whether they're A's and B's, I've got to say, are there substantive rights and obligations within each of these economic activities? And in that, I've already had to think about how would I spread any consideration or the amount of the transaction within it.
Mm-hmm.
And so that's my way of thinking, and that's how I would describe it. It's not totally just pure, what does the binding arrangement say? I've got to think about management's intent in order to understand the economic activity.
See, and so I just wonder, I guess, to close my thinking, whether we need to go that far and whether that would create confusion on other aspects of things. I mean, could we, because again, I'm thinking sequentially, right? And now we're at measurement. And so whether it could be handled as easily as for, a sentence that says for category A, for binding arrangements have category A and category B transactions together, the allocation should not change the categorization determination, period. And then you don't change categorization, right? You're saying you've already done that work. You've already done what Joel said. You already created your A's and B's. Now you're just shifting the dollars around, but don't change your categorization decision when you do that for this mashup of A's and B's. And therefore I've kept the integrity of my sequential thinking. I've kept it the same for all different types of transactions. So again, as staff considers ways to try to address this question, I'm not so sure that we have to go so far, but rather just create a link there to remind stakeholders that this is how this ties in. And what we don't want to have happen is have you change your categorization decision when you're in one of these, combined transactions.
Jackie.
I kind of agree with where Jeff is, because at some point they're going to have to make a call on how they're going to allocate the amount. They're going to have to make the measurement call. And that's where this whole unreasonableness question comes into play. So I agree with Jeff. Once they make the categorization, it's not how they allocate it that changes the categorization methodology. That's the measurement that comes in with the measurement thing. And they're still going to have to make a call on that, and they're going to have management judgment to make that call on how they're going to do that allocation. So I don't think that we're going to be able to take out the reasonableness or unreasonableness, because management judgment is going to have to come into play there at some point in time. And based on everything that we read about the problems with the word reasonable and unreasonable before, and what Alan and Joel have said about it, as much as I hate double negatives, I think in this particular case, it may be warranted. So I'm okay with leaving the double negative too, but kind of where Jeff is on this, that's the categorization call has to be made. And at some point later down, the measurement's going to have to be done on the allocations, and management's going to have to make a call on that, how they're going to do that allocation and what amounts are reasonable based on observable amounts if they're available.
Chris.
So I got the complete opposite out of Jeff's comments, and it made me lean more into Joel's, funny enough, because in my head, maybe I was just, two blinders on, but in my head, I saw looking at categorization and tying the intent of categorization down into the allocation removes the need for reasonable or unreasonable. It's just the allocation is based on the categorization and tying it in more cleanly. So I kind of got more to Joel's point of why do you need reasonable or unreasonable? Everything really that we're talking about is done with a level of professional judgment here. And so to move from the categorization to the allocation, as long as you root it in the categorization, then your allocation should be representative of whatever your categorization was. So I don't know. I'm spending I need a second to think through this stuff.
But don't you need, question for staff, but don't you need the reasonableness determination to figure out whether you need to estimate or not? Or are we saying, like we're doing it for the amounts that you know, that are observable from the binding arrangement, and as long as they appear to be not unreasonable, right? And so now we're saying, if we're saying, you know, now that we're doing this, we don't need it. Well, we need it because if you determine them to be not unreasonable, then you got to estimate. That's what we're saying, right? And we're saying that by virtue of doing this categorization thing up above, there's no need then to ever estimate, because you're gonna just take from your binding arrangement amounts. You're never gonna have to estimate. That's not striking me like that's a conclusion that's going to be the conclusion in all cases. But I think if we went down that path, that's in effect what we would be saying, right? If you take out the reasonableness determination, you never get to estimation. And we're
Well,
saying you
unless-
never need to estimate in these
Unless
combo
there's
eight.
no, unless the binding arrangement doesn't have observable amounts to get there, you have to estimate still.
Right. But I'm talking about, or they appear to be unreasonable, right? So
The only thing I would kind of a little bit not alarmed, but made me pause about your previous thing about we should just say you can't, you know, you can't, when you get to allocation, you can't override your categorization conclusion. I struggle with that a little bit in the sense of portraying it to be such a solid sequential type step. And then once you get to here, you can't go back and change what you thought up here because it's too late, you know, or something, you know. I think that is kind of contrary to, I think, the way what Joel's saying about when you're thinking about this is all melding together when you're thinking about categorization and allocation. If you were to say you think about categorization, then you move down to the steps, these sequential steps, and you can't change what you thought of before if you have more insights when you start thinking about the allocation. It scares me a little bit that that's a little rigid for how things really would work in the real world in terms of working through this process.
I mean, you could, I mean, I get that point. You could soften it, right? Because I think what I'm struggling with is this notion of mashing it together versus how it's understood versus how it would be done in practice after people are comfortable with it. Yeah, they're going to mix all three together because they know how to do it. But when they're figuring out how to do it, what are we asking them to do? I think it's like, okay, this is how I'm going to understand how I'll get to that place, right? And so maybe it's not a hard, you never do it, but maybe you say something like you consider categorization when you're doing your allocation decisions in these things, right? Like, or something where you just got to make them think that there's a connection there that they need to be mindful of.
But this is what I always come back to. How do I know I have a cat A and a cat B if I haven't already done that? Like in identifying whether there are substantive rights and obligations, I have to already allocate the amount. I have to know what the amount is related to that economic activity in order to make a determination of, is it something for something or is it something for nothing? Jackie.
I'm with you. I'm with you up to the point where you say you have to allocate the amounts before you can make a decision about whether you have a substantive right or not. I don't think that you have to tie a dollar amount to something to know whether you have a substantive right or not, or whether it has an economic impact. I think that you can make those decisions. And like I said, I'm up with you right to that point. But I think that the measurement doesn't necessarily have to drive your determination of whether you have something that has a substantive right or a substantive obligation. I can know that without tying a dollar amount to it. I know whether I'm obligated to do something for somebody because I said I was going to do it, and whether that to me is important, right? I don't have to tie a dollar amount to it. That was what we negotiated in the contract. We didn't necessarily tie a particular dollar amount to it when we were negotiating the performance obligation or whatever, but we knew whether it was going to be something that was important, was going to take time, whether it was going to take effort. And so we knew whether it was substantive. So I don't necessarily agree that we have to tie a dollar amount to it to make the decision on whether it's an A or a B. But I do agree with you that we have to identify whether it's a substantive right obligation has an economic impact.
And Jackie, you wouldn't have to do that any more than you would have to do with an agreement that had a bunch of A's to it. You wouldn't have to allocate the A's to figure that out. So That's why I'm like, do you have to allocate the amounts up there? I'm sort of agreeing with you. I don't know necessarily that you need to do that. But you do need to be careful because these particular types of transactions, you could mistake a B for an A because of their nature. And that's where we need to sort of serve some way of making that connection for them.
Has everybody weighed in on the unreasonable or not unreasonable? I think Jeff is the one who didn't. I think it was Jeff who has not.
I did
Did you?
throw it in there in the middle. Yes. As
Oh.
far as the question one answer,
I missed it.
I'm in agreement with yes, as it
So I had that
As it
as
stands.
4-3 for retaining not unreasonable wherever it is we use the. And then I guess, I think we've heard from everybody that everybody, well, at least a majority agree with this as a TBD, but also would like some more thinking by the team of how, of my thoughts and how maybe there's an alternative or some way of thinking to maybe mitigate some of the TBD, to mitigate some of my concern in some way, shape, or form.
That's my
Do you
understanding.
feel like you have enough to proceed? And
I think so.
okay,
And so I think what we're saying is that we have a TBD for this meeting for question one that's as the staff has recommended, and then we'll move forward to bring some other thoughts to the board about this idea that you've had in terms of somehow combining these thoughts into one. Okay.
that's good. Count me as having the no bucket on this one, but I think I'm the only one then. But at least we're exploring my thoughts. So
Sure.
I appreciate the board
Yeah.
being
Okay.
willing to do that and the team actually doing it. So thank you.
All right. So now we're on to question number 2. Which is, does the board believe that to allocate consideration from the total binding arrangement to each transaction within the binding arrangement, if the observable amounts are unreasonable or there are no observable amounts in the binding arrangement, then a government should select an allocation methodology based on estimation to determine the relative amount of consideration attributable to each transaction that maximizes the use of observable information.
Okay, board member responses here. Chris,
I agree with the staff recommendation.
Robert,
I also agree with the staff recommendation. I think the emphasis is outlined in the paper of unobservable information would provide a basis for the applicable use of professional judgment.
thanks, Robert. Jackie,
I also agree with the staff recommendation on this. I think there's going to have to use some kind of an estimate, but I do like the fact that we're reinforcing we should use observable amounts to the maximum extent practicable.
thanks, Jackie. Carolyn,
I agree with the staff recommendation. It's pretty much all I had to add to that.
thanks, Carolyn. Diane,
I also agree with the staff recommendation and what's already been said, using observable information as well as facts and circumstances, pulling it all together and coming up with your best estimate.
thanks, Diane. Jeff,
Yeah, and I guess the discussion here was, to be flexible, right, in terms of how we're approaching this estimation. And I agree with not being prescriptive about how we do that and following along what we did in Lisa's, where we talk about maximizing the use of observable information. And hopefully that this principle will lead to common enough practices so that there can be comparability. So that's why I was in agreement with that.
thanks, Jeff. So I'm not sure exactly how this goes with my prior concern, but in general, I guess if there what I thought I was left with was if there are no observable inputs within the transaction, you do have to do something. And if there is a way in my world that we have to do something, then I agree with what has been proposed here for the reasons my fellow board members and you pointed out in the paper. So I guess as we move forward, I agree with this kind of in principle theory. I'm not sure how it totally melds with what I think about question one, but I get that some of it could be in there somehow.
All right, thank you. So the next section relates to allocating the category A total transaction amount to each performance obligation. At your February meeting, you also tentatively decided that the objective for allocating the total amount in a category A transaction to each performance obligation is to allocate consideration in an amount that reflects what the seller is entitled to for transferring control of a distinct good or service to the customer. Project staff believes that governments should allocate consideration to each performance obligation because they are each a recognition unit of account. Therefore, the transfer of control of each recognition unit of account in the transaction may occur at different times, which would result in recognition of the receivable or payable at different points in time and potentially different for different amounts. The project staff recommends that the allocation methodology for category A performance obligations be consistent with the proposals for the allocation methodology for the total binding arrangement amount to each transaction, as you just discussed. That is, we recommend that governments allocate consideration to the various performance obligations in a category A transaction using observable amounts specified in the binding arrangement when those amounts do not appear to be unreasonable. In the government environment, observed amounts in the binding arrangement may include standalone prices. Standalone prices may provide a reasonable basis for allocating consideration and may include contractually stated or administratively established prices, even when those prices are designed to recover costs or achieve objectives other than to generate profit. In addition, if amounts in the binding arrangement are not observable, the project staff recommends that a government use an allocation methodology based on estimates that maximize observable information to estimate those prices using information from other sources, for example, observable information regarding costs of providing the various services. And the paper includes examples to illustrate the application of this recommended approach, including when observable amounts are specified in the binding arrangement and when an allocation methodology based on estimates is used. Statement 87 provides a practical exception provided as a cost-benefit relief that allows governments to treat a lease and a non-lease component as a single lease unit if it is not practicable for a government to determine a best estimate for allocating some or all of the components in the contract. However, in this project, we believe that providing an exception for the allocation of consideration among multiple transactions in a binding arrangement or multiple performance obligations into a single category A transaction would not align with the board's tentative decisions for both the categorization component of the model and the recognition proposals applicable to performance obligations. Therefore, we don't recommend providing a similar practical relief for allocation in this project. This brings us to question 3. Does the board believe that for category A transactions to allocate consideration from the total transaction amount to each performance obligation, a government should use observable amounts relative to each performance obligation in the binding arrangement, as long as the amounts do not appear to be unreasonable based on the terms of the binding arrangement and professional judgment? And we recommend this approach.
Thanks, Pam. So I'm going to start again, but it's not as bad. I don't think it'll be as hard. I just want to get your thoughts about a little bit of an idea that I would call a tweak-ish, but it's based in the same concern that I worry reasonable will be tied to fair value, and even within performance obligations, it's not equal value, fair value, whatever, equal value. It's not about equal value. It's something for something. So it really and truly what you did and your examples showed this. What you did was you used the observable inputs to determine the proportion. And then you applied those proportions, assuming they were not unreasonable, to the total consideration provided. And I wonder, I get that I might be risking making it a little more complicated in order to avoid this direct tie of equal value to when we don't want it, I guess. But I wonder if this could be reworded a little bit to say that, to describe what I just did, that the observable inputs are used to determine the proportion, making sure that the proportion or that the observable inputs are not unreasonable, with the proportion then being applied to the total consideration, total binding arrangement amount in order to allocate the amount to the various performance obligations. So I'm kind of bringing, that didn't word that very well, but somehow bringing the notion of what you're using the observable inputs to determine are reasonable or not unreasonable is the proportion. And then the proportion then is applied, I'm almost adding another step, the proportion is applied to the total amount to allocate it. Maybe that's just too complicated and people will be like, whatever, like just cut the proportion part out, even though you have to use the proportion as evidenced by your example. Like that is what you're doing. So I might argue this explains what we're doing a little better to kind of add that proportion in rather than adding a step that is unnecessary. So I don't know, hopefully I explained that well enough without exact words, but if board members have thoughts or if you're okay with it just as is. Robert.
So within the question, is it as simple as saying a government should use observable amounts in proportion to each performance obligation? Is that what you'd be proposing, or where it says relative to each? I mean, or is that oversimplifying what you're suggesting? Because it's really not each performance obligation, it's the observable amount in proportion to. So I'm trying to.
And again, we're talking about the question 3, which is
Right.
not the estimate. It's the amounts that are actually in the binding arrangement.
Right. So in theory, you don't get to proportion in this question if your binding arrangement amounts are reasonable or not unreasonable.
Or not unreasonable,
you
you
use
use
them.
them.
Then you use them, right? You don't have to
I
do
guess-
proportionality for that.
My argument is you're determining that the proportion is reasonable.
Right.
So what Robert said isn't exactly, is oversimplifying, I think, what I said, but
That's different than FASB where they say standalone selling price, isn't it? Because am I looking at the thing itself or am I looking at the thing in the context of the binding arrangement?
I'm jumping in. This is about standalone selling prices proportion to each other. So what you're doing is looking at all the standalone selling prices of every distinct good and service created in a proportion, and that's how you allocate the total binding arrangement amount. There may be circumstances in which the estimate of the standalone selling price is the same as the proportion, so you might not have issues. It would be a simplified version of it. But what you're dealing is with a complexity where you have a total contract amount in the FASB world. And then you have variable consideration, fixed consideration, contingent consideration, things that change based on CIP index or things of that nature. And if you don't have the proportion locked, which is the last question on the paper, then how do you know how to deal with this issue? So what you need to lock down is the proportion of each one of the performance obligations amount. So the language, you can see it in the basis of conclusions. It's in page 9 of your papers. It's in BC 266. And what it talks about is the proportion to the standalone selling prices. So it emphasizes very much to it that is the relationship among them. In the text of the standard, the word that is written page 7 in its paragraph 606, 1032, 29 talks about the relationship. The entity shall allocate the transaction price to each performance obligation identified in contract on a relative standalone selling prices. So it talks about the relationship between them. And then the basis of conclusions is more direct and talks about the proportion of them.
Jackie.
So I agree with the staff recommendation on this, and I think that I like the terminology, and I understand what Joel's saying, and I think that that would be the kind of thing that we would provide as guidance or additional information maybe on how to do this. I hate locking us into something that is so specific, where the term relative may cover something that's a little broader in how it's approached. So I'm fine with the wording the way it is, but using guidance of some type that helps them understand it, as Joel's pointed out, might be beneficial.
Thanks, Jackie. Chris.
Yeah, that's exactly where I am. I agree with the staff recommendation, and it makes a lot of sense. What I imagined as Joel was talking was whether ultimately it came out at some point in the future. And I know this isn't your intention, but like it just made sense to me as like an implementation guide, explanatory kind of, no, that's not the answer. And here's why you allocate, and so I got that out of what you were saying. And my concern would be kind of to your point a little bit that it might confuse or add a level of complexity. It's important, and I think it should help. It can help, but I think here it might add a level of complexity that we wouldn't necessarily want to introduce.
Thanks, Chris. Carolyn.
I agree with the staff recommendation. Hearing the conversation, my initial reaction was that if there was a way to emphasize that reasonableness is not fair value, I was open to expanding the language. But I know we're not there yet, but I'm also very supportive of this possibly being some type of demonstration through an implementation guide to kind of, give people, if they ask that question, like, no, that's not what it is. Here's what we're talking about, or something to guide them to the right answer. Because once again, I can see where a lot of people will tie reasonableness to fair value. So, but I do agree with the staff recommendation.
Thanks, Carolyn. Robert and Diane.
I agree with the staff recommendation. I would echo the comments that particularly that Carolyn just made in terms of if there's a way to do it without getting overly convoluted, to provide some additional guidance in not sure what fashion quite at this point, but it would be helpful.
Thanks, Robert. Diane.
I agree with staff recommendation. I like the consistency between allocating the consideration from the total binding agreement and then to the transactions as it all stands right now, and for question 1 versus 3. So I like that. And I think the wording's fine. I'd like to keep it kind of general so that people have the judgment that they're using, the observable information that they have, and being able to come up with the right conclusion. So I do think, as has been mentioned, there's other ways of addressing that.
Thanks, Diane. Jeff.
Well, you made it more complicated for me, Joel. But I thought originally I was sort of in the camp of everybody else, but something Paulina sort of said made me think that this language would work for like the simplest cases, right? And then we might have these cases where these other forms of consideration, and now if you use the language here where you're just using the observable amount, not the proportion, you don't have anything informing you later on how to allocate that other consideration to the performance obligations, if I'm understanding right. And so therefore, if I know that this performance obligation is 20% of my transaction amount, then whatever else comes down the line and I allocate it to that performance obligation, I allocate 20% of the thing to that performance obligation. If I make it $50,000, that doesn't inform me what to do with that other consideration down the line. Now, so I'm trying to see if I can split the baby here by saying, well, you know, could we write it in base form at its simplest case? But then is there some language that has to follow on that talks about for this other consideration, other types of consideration, you need to use those proportions that you figured out initially to be able to allocate those forms of consideration appropriately to those various performance obligations, right? And if you could do that later on, maybe I'll feel comfortable. Let's not make it proportion up front, right? Let's keep it at its base, most simplest to understand, but then having to do something, because otherwise then I think you might be stuck, right? You might be stuck. I got variable consideration. I don't know how to allocate it. And so I have to create something to do that. And so that's what the conversation made me think about.
That's not question 4 though. Is that different? Like we're talking about when you don't have the observable inputs, which I think, Jeff, is that what you're saying for, like, you got the observable inputs for a portion, but you don't have them for another, or you, I guess I'm trying to track.
Yeah, I mean, I think it's more cases where, like we're talking about, there's variable consideration allocated to the entire binding arrangement, right? That would apply to each performance obligation, right? And so if you have that, like you meet a milestone or something and your consideration goes up, steps up for the binding arrangement, how do you allocate that stepped up consideration to these remaining binding arrangement amounts? I don't know how to do that now because I just have dollar amounts applied to these performance obligations. I can do it if I have percentages applied to them. And I can take that additional consideration and say, okay, I'm going to apply 20% here, 40% here, et cetera. So I'm just sort of thinking ahead again to the more complicated transactions that may exist. I don't know if that's thinking about it in the right way.
I mean, I feel like the wording there gets you to that place because it's saying the amounts relative to each other. So, I mean, it gets by agreeing that if the amounts are not unreasonable, these are the amounts, but the relationship between those amounts is where it helps you if you had some sort of variable consideration or some other thing that you needed to then allocate to all of the performance obligations in the binding arrangement. So it gets you both of them, if I'm understanding what your concern is.
I wouldn't necessarily pick up on that with the word relative, right? I understand. I guess that's what FASB did in their guidance and then relied on the basis to sort of flesh out what we mean relative to, whether that's the best approach or not, or to just say, in effect, proportionally, like Joel's talking about, would be a more direct way to get to that, because I have to bring out my divining rod and go, what do they mean relative to each other, right? Like, okay, so now I'm supposed to mean, oh, that's twice as much, that performance obligation is twice as much as that one. So therefore I have to figure out, oh, that's what they must mean, rather than being more direct and saying proportionally, that would be more of a direct way to get at it. But I agree with you as far as how the precedent has been set. The precedent has been set that, but I didn't pick up on that when I was reading it that way.
I think even in the paper too, and maybe it's a question of the word, which I think you're pointing out, and to Joel's point, the words versus, like, in this paper, that's the whole crux of the paper, right? When we look at the examples and the proportionality and we do the simple math to get to the 50% or 80% or whatever the allocation is. But I guess you're just saying to just make sure that it's infused and kind of reflected more in the language, what we're doing. And I don't know about that one either, because it's tough because I followed through the paper, right? So I'm trying to separate how much of my how much am I educated and informed by walking through the paper and getting there versus how much am I informed by just the language that we used. And it's already happened, right? You can't separate it. I don't know at this point, but I think that paper gets us there and the intent is clear, but I guess it's a question of the language.
I mean, I will say we're working on a paper related to variable consideration, and I think that, that will become more apparent when you read that paper. And then I would also say that, of course, the board's discussed many times, and we're planning a lot of, examples, illustrations that would illustrate these types of, points.
Jackie.
And I think that goes to one of my concerns about using the word proportion there, because if you have an agreement that has both fixed and variable consideration in it, which is not uncommon, if you tie yourself into a proportion right away and then the variable consideration changes, your proportions that you tied in the beginning might not be valid anymore. So I think that the relative concept, to me, works better than the proportional concept, because you don't know if you've got a mixed contract what you're going to end up with.
All right. I think we essentially have agreement on the TBD, but some idea of proportion through implementation guidance or something will probably inevitably come out, or even in basis or whatever, but I don't think people disagree that that's a thing, but don't think that it's necessary to change the language to reflect it specifically here.
I agree with you. I worry a little bit that if we're sitting here right now going that we think we need to clarify the words in an implementation guide, I don't know why we just wouldn't do it now.
I wasn't suggesting we clarify the words in an implementation guide. I'm just saying that it would clarify the application of the words that are used.
You would show the
It would show
application
that.
of the words through an example, I think is kind of what people are saying.
We
I
have
think
those in
people
illustrations there, right? Potentially.
could. Yeah. And what I heard was the words are better as they are, and adding proportion in, even though that might be how it manifests at times or most of the time, would make it more complicated wording wise. And as a result, let's reflect it some other way, illustrations or whatever, without adding complexity to these words.
What you just said helps clarify it in my mind.
I'm not saying I agree with that, but I'm saying the majority of the board said that.
All right, so I think we're ready for the next question, which is question 4. Does the board believe that for category A transactions, to allocate consideration from the total transaction amount to each performance obligation, if the observable amounts are unreasonable or there are no observable amounts in the binding arrangement, then a government should select an allocation method based on estimation to determine the relative amount of consideration attributable to each performance obligation that maximizes the use of observable information.
Thanks, Pam. Robert.
I agree with the staff recommendation and the emphasis on maximizing the use of observable information, as we've talked about in our other questions. And I also agree with not providing a practical exception as it was provided for in 87 for the reasons stated therein in terms of upsetting the whole apple cart on this project.
Thanks, Robert. Chris.
I also agreed. I just thought this, made very simple and practical sense that you want to maximize those observable inputs when making that determination.
Thanks, Chris. Jackie.
I also agreed with the staff recommendation and with what Robert said. I don't think that there should be an exception either.
Thanks, Jackie. Diane.
I agree with staff recommendation. This is the similar discussion of question 2 and for the same reasons.
Thanks, Diane. Carolyn.
And I also agree with the staff recommendation.
Thanks, Carolyn. Jeff?
I agreed, and I also agreed along the lines of what Robert was saying. I recognize that may not make us the most popular people around, right? To not have a default where you can go and say, it's just a single performance obligation. You can default and put it all as a, because I think in a lot of these agreements, it's going to be hard. It's going to be complicated to figure out. And just like they were complaining in leases that, we need to have this fallback, and they got it there, and I agree with they shouldn't get it here, but I'm acknowledging that I think that that's going to be in some quarters, not a popular decision.
Thanks, Jeff. On question 4, while I would have probably still woven proportion in, especially given what the board decided on question 3, I would agree with question 4 in light of that, because I agree with it in principle, for sure.
So the last section of this paper discusses the timing of a government's determination of an allocation methodology and whether that methodology should be reassessed periodically. As the board has tentatively decided, the objective of allocation is either to allocate consideration in a manner that provides a faithful representation of the economic activity of each transaction, or in a Category A transaction, to allocate an amount that reflects what the seller is entitled to for transferring control of a distinct good or service to the customer. Project staff believes that these objectives are achieved when the allocation reflects the relative amounts in the binding arrangement at its inception. We also believe that once an allocation methodology has been applied at inception, subsequent changes in standalone selling prices, cost structures, or other information used to estimate the relative amount of consideration to allocate would not necessitate remeasurement of the allocation, because doing so would result in an allocation that no longer reflects the provisions of the binding arrangement as it originally entered into. In other words, reassessing the allocation of consideration would not enhance representational faithfulness, but instead could obscure the economic activity that is embodied in the transaction. We also note that implications related to modifications of a binding arrangement are planned for a future meeting. Based on that analysis above, we propose that the allocation methodology should be determined at the inception of the binding arrangement, and that once an allocation methodology is established, it should not be reassessed each reporting period. So I'll pose question 5. Does the board believe that the allocation methodology should be determined at the inception of the binding arrangement? And that's the project staff's recommendation.
Thanks, Pam. Question 5. Diane.
I agree with staff recommendation by determining the allocation methodology at the inception of the binding arrangement. It provides a faithful representation of the economic activity in the transaction.
Thanks, Diane. Jackie.
I also agreed with the staff recommendation that we need to make the allocation methodology at the inception of the binding arrangement. If you don't have some type of an allocation methodology, you really don't know how you're going to capture the recognition part of it. So you have to have something there before you can recognize it. So.
Thanks, Diane. Sorry, Jackie. Thanks, Jackie. Chris.
I also agree and echo Jackie's comments.
Thanks, Chris. Robert.
I agree with the staff recommendation.
Thanks, Robert. Carolyn.
I also agree with staff recommendation.
Thanks, Carolyn. Jeff.
So I agreed too. I guess we have two things going on here. One, the two different ways you could allocate. You could allocate from the amounts in the agreement itself, or you could estimate And I think we're saying that you're going to do this in inception and you're not really going to change it unless we'll have this discussion about unless your binding arrangement is modified, in which case maybe your amounts could change, your performance obligations, could change, and we'll discuss whether, you should change this amount. I also appreciated the paragraph that was put in here to sort of distinguish this from the, satisfaction of performance obligations, which was a thing we talked about doing every period, right? So as you're determining whether that's a dynamic thing. You're determining that every period versus your allocation decision, absent a modification, is a static thing. It's set up at the beginning, but those are two different things done for two different purposes, right? So that made sense for one to be static and one to be dynamic. So I agreed with the staff recommendation.
Jeff, you really seem to talk about question 6 more than 5, right?
Did I got ahead with
Question,
6.
you did question
But 5.
Question 5 is about timing. Like, when do you do it?
Yeah,
Not how
no.
often and do
I
you-
agree with the timing. I sort of
Okay.
launched into
You
going
s-
beyond
I think
that.
you started there and
I
then
started
you just,
there.
you
And I
just kept going.
Yeah. So count me in on 6 too.
All right. Thanks, Jeff. I agree with the staff recommendation here as well. I mean, we want these, as Diane pointed out, and the paper points out, this is allocating based on a faithful representation of the economic activity within the arrangement. And I would add into that, it's driven by the intent of the parties as they entered into the contract. And so we want it to reflect that. So doing it, the allocation as of the inception of the binding arrangement, makes good sense to appropriately reflect that. So now question 6, yeah?
Yes. Question 6 is, does the board believe that once an allocation methodology is established, it should be reassessed at each reporting period? And the project staff recommends that it should not be reassessed at each reporting period. And kind of as Jeff alluded to, we're going to be talking about contract modifications at a future meeting. This is really establishing kind of a base or foundation for those discussions where, potential other things or exceptions to this could be added on at that time.
Thanks, Pam. Any other thoughts, Jeff, or you're counted in? You're done. Vote is in. Jackie?
I agree with the staff recommendation on this. Just because one item in the contract might be suffering from more severe inflation than the other doesn't mean you go back and relook at how you did the allocation. Modifications is a totally different thing, like you said, and that would be looked at. But based on what our discussion is, I agree with the staff recommendation.
Thanks, Jackie. Chris?
Well said, Jackie. And I agree with the recommendation. It's easy going after Jack.
Thanks, Chris. Diane?
I agree with staff recommendation, and it does go back to the representation of the economic activity of the original transaction, and you don't want to alter that. So I think it makes sense.
Thanks, Diane. Robert?
I agree with the staff recommendation.
Thanks, Robert. Carolyn?
Oh, I also agree with the staff recommendation.
Thanks, Carolyn. And it is really, it kind of flows, which is why Jeff just kind of kept going earlier, right? It does kind of flow. And I agree with the staff recommendation as well, subject to dealing with modifications at a later date and a later paper. 10 o'clock, going to paper 2 might be a good chance to break and come to paper 2 after. Let's come back at like 10:15 and we'll start paper 2. Thanks, everybody. All right, welcome back, everybody. Hope everybody had a good break. We are in our revenue and expense recognition, moving to paper 2. I can talk really well now after my break. Pam, I'll turn it to you to start us off.
Thank you. And so I will in turn it over to Mary Beth, who's going to walk you through paper 2.
Thank you, Pam. The purpose of this paper is to facilitate the board's deliberations regarding the recognition unit of account for transactions with qualifying requirements. Since the issuance of the preliminary views, the board has made several tentative decisions regarding the recognition principles for transactions with qualifying requirements. Notably, the board has identified 3 criteria for qualifying requirements. 1, the incurrence of qualifying costs in compliance with all other applicable requirements. 2, other qualifying requirements that are specified actions of the government that are not associated with the incurrence of qualifying costs. And 3, characteristics of a non-governmental resource recipient that are not associated with qualifying costs would constitute an additional criterion for a qualifying requirement. Also, the board established the following recognition principle. For revenue transactions, recipients should recognize assets that are receivables for transactions that are subject to qualifying requirements when or as the recipient complies with all applicable qualifying requirements. And for expense transactions, providers should recognize liabilities that are payables for transactions that are subject to qualifying requirements when or as the recipient complies with all applicable qualifying requirements. Based on those tentative recognition principles, the project staff believes that the recognition unit of account for transactions with qualifying requirements would be based on the nature of each qualifying requirement itself. Specifically, that would be each dollar of qualifying costs for qualifying costs or each incremental qualifying requirement for qualifying requirements other than qualifying costs. The project staff believes that these recognition units of account reflect the manner in which binding arrangements for transactions with qualifying requirements establish a government's entitlement to resources. The paper includes examples that illustrate the application of the unit of account for these 2 types of qualifying requirements. The board also tentatively identified characteristics of a non-governmental resource recipient as a type of qualifying requirement for certain expense transactions. These arrangements typically involve governments providing resources directly to individuals based on specified characteristics and generally do not arise in conjunction with qualifying costs or other qualifying requirements. Accordingly, the project staff recommends amending the December 2025 tentative decision to clarify that characteristics of a non-governmental resource recipient criterion are not associated with the incurrence of qualifying costs or other qualifying requirements. The project staff believes that a qualifying requirement based on a recipient's characteristics does not establish incremental recognition and is satisfied only when all specified characteristics of that non-governmental recipient are met. Therefore, the project staff recommends that for transactions with qualifying requirements that are the characteristics of a non-governmental resource recipient, the recognition unit of account should be the transaction. The paper also includes an example to illustrate the application of the unit of account for this qualifying requirement. The example describes a state-created property tax rebate program that returns a predetermined portion of its unassigned fund balances to its citizens based on property ownership, and the recognition unit of account for the state would be each transaction with a property owner. Finally, the project staff acknowledges that some transactions may include multiple types of qualifying requirements, such as a combination of qualifying costs and other qualifying requirements. For example, a government may receive a grant to upgrade roadways that is reimbursable for qualifying construction costs, but it is not entitled to reimbursement until it completes upgrading 20 miles of roadway. In those cases, the project staff recommends that the recognition unit of account be the last recognition unit of account for which the qualifying costs or other qualifying requirement is met. With that, I will now pose board discussion question 1. Does the board believe that for transactions that include qualifying costs, the recognition unit of account should be each dollar of qualifying costs, and for transactions with other qualifying requirements, the recognition unit of account should be each incremental other qualifying requirement, and for transactions with qualifying requirements that are the characteristics of a non-governmental resource recipient, the recognition unit of account should be the transaction. And the project staff recommends all these recognition unit of accounts for the transactions with qualifying requirements. And for this paper, there are no task force members that expressed feedback on the project staff recommendations.
Thank you, Mary Beth. So I'm going to start again. 1A and B, I agree with the staff recommendation. I think question 2, which we haven't gotten to, is really important. Appreciate you addressing it. I think A and B make a lot of sense, given the types of qualifying requirement we're addressing, whether it's costs in A or the others in B. I think the other qualifying requirements generally will be pretty straightforward and we will know when those are met. So I agree with all of those. Question 1C is, I guess, forgive me, board, I have not let go of disagreeing that this is a part of qualifying requirements and wouldn't better be grouped in somehow with legislative binding arrangements within grants and aid. And to me, this having to work through this part of the project almost shows that even more, that the example used, the government has too much fund balance and they're going to distribute it to property owners rather than trying to say those are qualifying requirements. That's just general aid we're giving to property owners. And rather than the recognition unit of account now needing to be transaction, which is a little nebulous, maybe not too much, but a little nebulous. If you look at the recognition unit of account for general aid, it's the date the payment is due. And that's going to be more reflective. I mean, what these kinds of programs, at least that example of them, which was one of the most prominent examples of this notion of characteristics being another qualifying requirement, legislature is going to say, got too much fund balance, we want to give it back. Here's how we're going to give it back. They're going to pass legislation. They're going to put it in the budget. No obligation there yet. The fiscal year is going to start. Maybe the legislation said we're going to pay it out on September 30th. At any time up until September 30th, they can change their minds. They can do whatever. Yes, there's a legislative binding arrangement at that point, but the state doesn't have an obligation until the date comes when the payment is due. This isn't all that different than the state providing grant and aid to school districts. The school district exists. It has the characteristics that it's a school district. And we kind of created this unit of account of when the payments are due, when each quarterly payment is due to the school district for that same reason, that's when the state pays it, and it might change its mind along the way. And we might look at that differently at some points in time. But you're not going to recognize it all up front for the school district and all up front as an obligation for the state. It's when the quarterly payments are due. This might manifest in the same way. It sounds much more similar to me to those than it does to anything else that has to do with qualifying requirements. So I think in my mind, I still think 1C isn't a qualifying requirement and would be better repurposed over in grant and aid. But I'm interested to see if I've brought any board members along with me on that now that you see it playing out. But I agree with 1A and B. Jackie.
So based on your adamant defense of your position on C, I guess I'm interested in the staff's feedback on it.
Sure. So we had been planning prior to releasing these papers. We had been, as we're working through various issues in the project as they relate to category A transactions, we have, some place to look in terms of, how GASB, for example, has approached certain things. When we're looking at category B transactions and we're talking about things like recognition units of account, we're kind of, going where no man or woman has gone before in some ways. And so, and there's many different types of category B transactions. Of course, there's many permutations of how they work in various governments and for various purposes. And so we've kind of gotten to, I think as we were kind of building this paper, we kind of gaining some insight as to maybe what we're feeling sure about versus maybe what we're feeling potentially a little more wobbly about. And so I've been planning to bring a paper to the board in the next couple meetings to kind of relook at the landscape of those category B transactions, looking at more examples, more in-depth examples, doing just trying to shore that up a little bit. So as Joel's comments, about, as he just described about the recognition unit of account for this, this type of qualifying requirement that the board has tentatively decided on, I think he has some really valid issues that he brings up related to this one. And so I think that we'd be very open to, exploring that a little further and seeing if we really arrived at the right place, or if the board should, maybe take another look at that or not. I mean, we haven't developed the paper yet, but I just think it's definitely worthy of taking a second look at it.
Jackie.
So I support the staff recommendation. Not ready to throw it out yet, I don't think, but based on what you come back on, because this was one example. And I do believe that non-governmental people can be a little bit different than grant people or grant entities. So I agree with Joel, but I'm not 100% there on this yet, because there might be situations that I'm not thinking about that you see or could come up with, that because these are individuals as opposed to entities, might still make this necessary. So I'm right now agreeing, but I'm interested in what you bring forward.
Chris.
So I agree with the staff recommendation and still do. I think Joel raises a very interesting point, and with his example, I immediately went to our example that we did a couple of years ago when governments were a little bit more flush with cash, and we gave all Delawareans who were personal income tax payers $300 back, right? And in my mind initially, before this conversation, I was just thinking, oh yeah, they were eligible because they were they paid income tax. There was a validation, much like a eligibility requirement for grants. But as Joel brings it up, it does feel more like a grant and aid kind of issue, like a legislative issue, than that contractual granting agreement that we're talking about in the other cases. That all said, I am probably where Jackie is, where I would like, and maybe this is where Joel is too, right? To flesh that out a little bit more, to understand what are all the circumstances, because where my mind first went, that makes 100% sense. But are there other places to the constituency where governments are doing something similar where it doesn't quite line up, and we might not be able to take that approach in every case? So I'm interested to see more of, is that the universe, or are there other circumstances where it might not quite apply, and then taking it from there? But in these circumstances, I think it makes a lot of sense.
Thanks, Chris. Carolyn.
I agree with the staff recommendation. I think I just said that I do believe extra education will be needed, as I can see where there could be confusion as far as how to apply this. Coming to what Joe brought up, I agree with both Jackie and Chris. I was thinking for the example that's in the paper, I can see, where Joe was not 100% there, but there could be situations where this is the correct approach. So I would be definitely supportive of exploring, more examples a little bit more fully.
Thanks, Carolyn. Robert and Diane.
I also agree with the staff recommendation, and I'd be supportive of the additional effort. But Joel, on your question, if I look at the table, and I'm skipping ahead on page 8, so where would you would this be under the general aid with the periodic appropriation?
Yes.
Okay, I just wanted to clear, because you're saying it's not due until a certain date, versus if the government, the state in our example, decided to do this program, are you getting more at the timing of when the payable is recognized? Yeah, I'm just trying to understand. Okay.
I think it's a better reflection, because I think the characteristics of that transaction align better with general
Align with
aid
that.
than they do
Yeah.
with qualifying requirements, because there is no qualifying requirement. And
Mhm.
we've kind of said we've had to make up this other qualifying requirement. And I
Yeah.
think that's just made it more complicated
Yeah.
than it needs to be. And it aligns better with the timing and recognition we've applied to general aid.
General aid, okay. Just think it would be helpful, and I'm not sure where we had examples on what fits more into, quote, this bucket, the characteristics of the non-governmental recipient. If there are ways to, I mean, maybe is it the example we're using versus that there are other types of transactions that governments have that fit that type of category B transaction, I think might be helpful as we're going through this other analysis that other board members have discussed. So, but I support the staff recommendation.
Thanks, Robert. Diane?
I agree with staff recommendation, and I thought the example was helpful, but I hadn't considered it the way Joel is describing. And so I'm open to what the staff brings back and, how you dig into this a little bit further, and we'll see what happens.
Thanks, Diane. Jeff?
Yeah, so I had to rethink through the whole difference between B and C, right? Because I was, sometimes when I was thinking through that, and it's sort of where I landed was, well, with C, the government doesn't actually have to do anything. They don't have to take an action, right? You're a property tax owner, therefore I send you money. Or I think in the prior paper, maybe we used like home heating oil subsidies or something like that. Like you qualify for that, I send you a subsidy for your home heating oil. I don't have to do anything for you. There's no qualifying requirement other than you are who you are. And so, so I got comfortable with that. And then when Joel raises his point, it's like, well, and it is because we talked about like shared general aid is like, okay, I send it to school districts because you're a school district, right? There's nothing else about you. There's no other actions happening. It's just you are a school district, therefore I send you money. And so now we say, now we're just dealing with a non-governmental version of that, right? You're an individual. So now we say general governmental or non-governmental aid, right? And so I'm having a hard time now creating what's the difference between those two cases. And so that's where I'm like, okay, got to be thought through more, right? So I'd be open to see and determine, right, is there any distinction up between those two, or is it better like to not create this maybe somewhat artificial distinction with a qualifying requirement and lump it where it goes when you're dealing with aid to governments, except the only difference is this is not a government. So I'm agreeing with further exploration.
Thanks, Jeff. We feel good about where
I
you're
think that's
going with
everyone.
that one then?
Yeah, I think so. And as I mentioned, I think, we're anticipating that there would be, other things included in this paper as well. For example, Joel mentioned pilots in the previous paper. That's another area where we feel like we need to flesh it out a little bit more. So.
Great. Now I will pose board discussion question 2. Does the board believe that for transactions that include both qualifying costs and other qualifying requirements, the recognition unit of account should be the last recognition unit of account for which the qualifying costs or other qualifying requirement is met? And the project staff recommends that it is.
Thanks, Mary Beth. Diane?
I agree with staff recommendation, and you've got to work through all the qualifying transaction requirements before you get to the actual end result. So the recognition of unit of account. So I agree with staff recommendation.
Thanks, Diane. Chris?
I agreed with the staff recommendation, but the one item of concern I had, just thinking through some qualifying requirements, was maintenance of effort with the single audit. So the way maintenance of effort requirement works, when you're granted certain funds for some social service or some other grant program, you're required to maintain the same level of effort that you did before you got the money, right? So it's that you're not supplanting, or you're not supplanting, you're supplementing, right? And that's actually the language they use: supplement, not supplant. And so the concern there would be that you usually don't know you made it until the end, right? Now, in the past, right or wrong, when you're evaluating and looking at this from an auditor perspective, my thought was always they have a separate appropriation. That appropriation is dedicated to whatever this purpose is, and the people, or the subset of eligible recipients, aren't going anywhere, right? There's not going to be a mass exodus from the state. And so that will be met, whether it's met on September 15th, right before the end of the federal year end, or it's met on, June 30th at the end of the government's year end. It will be met. But the concern is that what position does that put a government in with a hypothetical June 30 year end, where their maintenance of effort has not yet been met? Arguably, you would say that you cannot then recognize that you don't really care about during the year, right? You really care about as of the reporting date. And so what happens as of that reporting date is ultimately the question. I think in everything that I can think of, it makes sense on every other level. But the issue there would be to either tell governments to front load, which which you can, right? You can front load some of those expenditures to make sure that by that point in time you reach it, and it might involve reorganizing some things, and that's the workaround there. Or, hey, you don't get to recognize that revenue and those related receivables, even though that federal government agency is allowing you to do drawdowns all during the process, because it's assumed that you're going to make it, right? And so, I talked a little bit with the team about it, and it became one of those, I don't know if it's just standard practices that everybody understands that you just have to make this and you're going to make it, and so it's not an issue, or if it is hey, governments are going to have to reorganize how they do things, because when maintenance of effort is involved, it's fundamentally different. But I just wanted to bring that up, not necessarily as a deal breaker, but just as an item that needs to be considered and thought through when we move forward with this. The last qualifying requirement is the one that will allow you to recognize.
Chris, I guess when I think about maintenance of effort, we had administrative requirements, and we had, what's the other thing called? Post
Grant.
post something requirements that
Requirements,
weren't qualifying requirements, such as the requirement that if you use federal dollars on equipment, you've got to, for the life of that equipment, keep it on, you got to keep the record of it in your capital asset ledger. You got to identify it as federally sourced, so that if you ever disposed of it or sold it, you got to put that money back in the program or send it back to the government. But we're not making you, that we don't treat that as a qualifying requirement that would delay recognition. Otherwise, you have to wait till the end of the useful life to recognize the revenue for the equipment. I would view maintenance of effort similarly, right? But as my experience in auditing it, if the maintenance of effort period wasn't the same as the fiscal year, I still had to monitor progress and reasonableness and make a determination such that even if you've used all the money up to date and you still had time to maintain your effort through expenditures somewhere else, I didn't disallow cost or make you spread your allowable costs anyway. Based on their plan, if it seemed reasonable they were going to continue, as an auditor, I concluded at year end that they still seem to be on track to be in compliance. And so I think of it more as a post, whatever we called it, post award or post grant requirement, rather than a qualifying requirement. If that makes sense. That's how I thought about it.
And that's how I thought about it too. But in light of this paper, this is fundamentally different what we're very explicitly saying, right? And we're not talking about post award. You were talking about, and my history is post year end for the entity, not post award, right? You're still within the award period. and you're making a decision, just like governments make the decision sometimes with matching. And they say, hey, we want to match all up front. We know we have this appropriation and we're going to run through this money and we're going to spend it by year end and get there from a matching perspective instead of doing transaction by transaction by transaction, which is also, which you could also do. So I get your point, and that's where I'm grounded in your point. But what I'm saying is, does this change it? Because it's not really a post-award issue. It's a during the award. You are required, just like matching, to meet this during the award period. You can't really figure it out until the end, right? If it was 800,000 and you get to $1 million, but you don't get to $1 million until the last month, that's when you know it. And so that's my yellow flag that I'm raising of caution to say, I completely agree with you, but based on how we define this, it doesn't fit into that box for me.
I think in our discussion, after you and I talked, Chris, and especially with some of the auditor that have more of an audit background, it was very much akin to a Davis-Bacon type requirement or any types of things that you're kind of presumed to be complying with as you go along. And until there's evidence otherwise, it's generally considered to be, in alignment with those, what we call today eligibility requirements. We weren't intending to change the nature of anything with this proposal. It's, the term qualifying requirements is part of kind of our effort to distinguish, as we've talked about so much throughout the project, that there's some lack of clarity perhaps in governments in applying eligibility requirements, time requirements, purpose restrictions. And so we're really trying to just hopefully clarify the terminology around those things to make it easier to, distinguish between those things. And so I think there's a lot of things that are part of federal grants that people are presumed to be complying with as they go along through the grant period. And this may be one of those things, it sounds like, that works that way in practice.
Yeah, and I agree with all of that, but then that slippery slope of what if some other item is introduced into another grant, right? That is similar, that before the end of the grant, you need to meet this and you get all of this, right? Would our practice be the same, right? Do you still get the same pass on an assumption, or do only certain things qualify for that pass? And so do they need to be called out specifically? I don't know that there's a universe. I don't know what the universe is. I don't know that there is a universe outside of this, this one item or so, but how do you get consistency when then you have to, making this up might be completely crazy, but you have to also finish and build and open a hospital at the same time that you're getting all of this funding, right? And so that's something that you're not going to be able to know until around about the end of the granting period, presuming that the granting period matches the construct, all these assumptions, right? And so do we treat them the same way or differently? And if we treat them differently, we just need justification for why we would treat one thing differently than the other, is basically what I'm asking. Because again, I agreed with the staff recommendation. I'm just trying to figure out how then, for people that might say, hey, what's going on here, how we get them to that point.
I'm going to take that one. I would love to put you in a time machine and take you back to the pre-PV issuance. I think if you remember, the board considered the research that we performed, and I think at the time, I'm going to probably botch the last few numbers, but it was over 1,732 federal domestic award assistances that we had identified applicable to governments. The team was a wonderful PTA and a group of people who help us very thoroughly to walk through those qualifying requirements, and that's how we came up with a model that Pam alluded to. The administrative things that would never affect recognition, the post-grant compliance, which only affect recognition if you missed compliance. And then we identify a big bucket of things through OMB Super Circular, the federal awards, and all the work that we did. And we felt pretty confident that those are the kinds of things that our government needs to do through the life of the program. Now, very openly disclosed, this was a federal grant review. state reporting requirements are always the wild card, and every state may come up with different things. And so that's always the difficult issue. But what we had identified at the time when we presented this research to the board is that we were comfortable with these 3 buckets, and there were odd things like Pam alluded, Davis Bacon, your service effort, Jim always honed on the service effort to make sure that we looked at it as something that went along, while testing may have to be at the end because, it's hard to determine throughout the year. Programmatically, in my experience, when I manage those grants, I review that every payroll. I gotta make sure in every payroll, I have the police officers associated with that grant that match the program requirements to not supplant and run into trouble at any point in time. So programmatically speaking, a government tends to have to manage this very periodically. And so because all those requirements went in conjunction, we felt that the concurrence of qualifying cause was representational of all the package of the unit of account, and that's how we proposed what we did at the time, and that's how we have carried on the proposals. We have spoken a few times where there are things that can change practice and cause bumps. The biggest example that we always talked about is the milestone. And so if a grant has a milestone plus cost, then you're going to have to delay recognition until the milestone. And that's a professional judgment issue that is going to have to come up with, and it probably have to include illustrations to make sure you compare and contrast the cases where the qualifying requirements can be bundled and comply and be evidenced by the incurrence of qualifying cost, as opposed to the circumstances in which you would have a milestone that essentially delays recognition at that point. My experience, and I alone, I don't have them frequently. I've seen them, but it was not my most prevalent circumstance. From our review of the federal domestic awards, they were not as prevalent as I would have assumed. And so this is where the professional judgment of what falls into the qualifying cause bucket and what falls into the other qualifying bucket, which is what gets you into this trouble, gets you to. And so the unit of account that the team proposed is intended to just show that combination. And so if you put all the qualifying requirements and the cost gets you there, then the unit of account is the dollar. But if you have qualifying requirements plus a milestone, then that's why the wording, the way they have crafted, was intended to get you to the last compliance requirement of this bundle of things that you needed to do. Did that explain?
That helps me understand where we were at, which I felt comfortable where we're at. And maybe as you were talking, I thought more of it, whether it's allowed or not, but it's not, if you don't view it as a milestone and you take a step back, just looking at this specific instance, right or wrong, and you say, okay, if this is a maintenance of effort exercise, just like it's an allowable cost exercise, right? You can only review what's available to you as of a point in time. And so maybe for argument's sake, as long as an entity wasn't at 0, 8 months into the year as of the fiscal year date, 8 months into the granting cycle as of the fiscal year end date, then you're good, right? You're maintaining, just like when you look at allowable costs, right? You pick a sample of allowable costs. You don't pick all of the allowable costs. So as long as you're within, for that piece that I've reviewed as of that point in time, you should be recognizing it unless I find specific reasons not to.
Right. And a lot of times, I think some of the discussions that we had to do an awful lot with internal controls, right? I mean, you cannot revise every single dime that you have in your grant programs to ensure, but you have your internal controls around it that you go, oh, that program is in compliance. Then you have people doing grant draws. You don't just draw, you're making a certification that your draw is in consistency with. So there's a lot of people who have to touch those dollar amounts that gives you a reasonable basis to make an assertion that you have complied. And so I think we haven't potential in the project developed to that level of detail, but that's how we envision it would continue to operate. I think that the proposals in the project, what it does create is a very big degree of awareness of the things that were mentioned in the paper. First, this whole matching at the front or at the end, which we hear. Oh, I think that's a measurement problem that you're not going to be able to continue. Highlights this issue of if you have a milestone and other qualifying requirement outside the cost package of requirements, it may delay your recognition. So I think it highlights these issues that may exist in practice. But what we're trying to do is align very closely to the terms and conditions of the grant agreement. And so I think that's the reflection of the unit of account was just thinking through and putting all that together.
And that makes sense. And I think that, so those instances like the matching, which was also one in the head, it's just like, we will just need to make sure that there's the appropriate education on the front end to know, hey, this is different than how we've done things before. Before we had flexibility to do it all different types of ways. Now, you got to be on point with it.
Understood. And I think that's one of the challenges, benefits, whichever way you want to see it, of providing more prescriptive of direct measurement guidance, even if it's a principle-based level measurement. I think the provisions of Statement 33 are very short in measurement, and I think that causes some challenges. And so by being more explicit about how we would like you to think about measurement may cause you some shifting that affects recognition. So this is Jeff was alluding that the linear thinking, categorization, recognition, measurement, they're all married together. The food is going to touch your plate. I'm sorry. You're not going to have little dividers. And so we have structurally developed the work and the thinking that way, but the food is very much touching.
Can I just mention at this point, the board discussion question is worded that the last recognition unit of account has been met. We've got a few questions on that, the last word. And I think if you think about it, it's really not always the last. You could have additional, dollars that you're going to haven't spent yet. And so, but you still can recognize if you, like, as Paulina just said, met your milestone. So we're going to, if the board, maybe I'm jumping ahead, agrees with this question, we're going to work on that little aspect of the wording of this recommendation.
Because all that was getting at is in a construction contract with a milestone where the unit of account is every dollar of cost, right? You can't use every dollar of cost. What you really got to do is that last dollar that gets you to that milestone is actually when you recognize, and that's not really the last dollar of cost in the project because there's dollars after that milestone. It was just that last dollar that got you to the milestone is what that last was referring to.
Yeah, I think the concept as we talk about it,
Right.
we all understand, but it's when you put those words down, it's hard to articulate it for some reason. It's kind of those things in combination. It's the words we used in the paper, as she just said. And so I just want to mention that at this point.
Another point, I don't know if you want to continue on that, but just following up on Pam's point, I've struggled with that point too, for another reason, because it made it sound like, 'cause we're trying to sort of describe here the recognition unit of account. It made it sound like when you say last, that there are other recognition unit accounts in front of it. But they're not, right, as it relates to every dollar, because if you have a milestone, because we're talking about the combination, when you have every dollar, those are not recognition unit accounts. They only become a recognition unit account when the milestone is met. And the combination, so it's not the last recognition unit of account, because those other things before it weren't recognition units of account. They were just dollars spent. What makes it a recognition unit of account, right, is the combination of the two things being met, right? Which is, so I agree that in concept, I understand what we're talking about, but what we have to work on is to get the wording to the same place.
So Chris, are you good? Or it's just, I mean, when I read the definition of what a qualifying requirement is, at the end of it, it is essentially something that has to be met in order for, trying to find it. required to be satisfied by the recipient before said recipient is entitled to the resources. And so some of the things we've been talking about, costs or Davis-Bacon that precedes cost or these other milestones or whatever, you have to do them before you're entitled to the resources. Maintenance of effort, I would almost argue, isn't something, I would argue it doesn't meet that description of a qualifying requirement. It's still a requirement, administrative, whatever you want to call it. It doesn't make me not entitled to the resources at a point in time.
I disagree. I think it
Okay.
absolutely does. But in my mind, the workaround is that, again, as I said, these governments have established appropriations to pay for this, and they have figured out that this funding stream is this over these 12-month period of time. And whenever you bring up maintenance of effort, even though it's not at the end $1 million amount that you need as of the, for the grant agreement, they can point out we're 2 months in and we've spent $200,000. So we're on track. And you're like, okay, there's nothing to see here. But if they were to say, oh, there's no appropriation, but we expect because it's going to cross fiscal years, we're going to petition the General Assembly to get an appropriation, and then we're going to run through that $1 million and spend it all. And then, whoa, I don't know that you're entitled to these funds. You don't even have a plan. You don't even have a process. You got a plan. So in my mind, that's how I'm getting there, because at least the ones that I've been through, it's what they always do. It's what they've been doing. The train's continuously running. And even though they haven't hit that mark yet that they got to hit at the end, they're showing me that they have a process to get there every year. So in my mind, that's how I get there.
Okay. So we just have to be cognizant of that as the words get on the page to be sure they reflect that in some way, shape, or form.
But again, that matching one is big for some organizations too. So
Yeah, understand. It's not dissimilar depending upon the grant.
Right. And again, I agreed. It's just that education, making sure we're as upfront
Okay.
as possible to
Okay.
make sure people understand.
All right. Thank you. I really got into trying to figure out I understood what Chris was saying. I was trying to figure out how I thought about it, work around it. And I'm saying that because I totally forget where we are. I have no idea who's answered the question, who hasn't.
I think I've
Um,
only heard from Diane, Chris, and Jeff in terms of their
Okay.
response.
Thank you. Robert.
I agree with the staff recommendation. I think the conversation has been enlightening though. And I look forward to getting more information, as someone said, getting words on paper. I don't know if that's your words, Joel, or Chris's, but I think it will be helpful.
Thanks, Robert. Jackie.
I also agreed with the staff recommendation. I think some of the things that we're bringing up go to the complexity of revenue recognition, and they're not unusual or unencountered situations. We know FASB has had to do this too. Education is going to be critical to making this work for everybody, and just making sure that we're listening to what happens afterwards. But it's going to be complex. And as Chris points out, we're going to need to help make it clearer for those that are going to have to enact it, what the intent was by some of the words that we're using. So I agree with the staff recommendation.
Thanks, Jackie. Carolyn.
I agree with the staff recommendation also, even though I didn't say it on this one. I also agree that education is going to be needed for our stakeholders, but I do agree with the staff recommendation.
Thanks, Carolyn. So I agree with the staff recommendation. We've got to be really kind of precise with the words and the last of what, and you've kind of mentioned some of that you're working on. I wasn't totally getting at what Chris said, but as I sat here thinking through what Chris talked about, we did Cat B a while ago. We've been dealing with Cat A, which is its own unique, complex beast, but it brought back all these complexities, especially around grants and this criteria that I had kind of like, we got that down. And now I'm like, yeah, it's still gonna be hard, but this principle absolutely is the right principle. And then we just have to make sure we deal with Chris's issues and all the issues, and it's gonna be fun.
Okay, now I will pose board discussion question 3. Does the board believe that the tentative board decision from its December 2025 discussion of the characteristics of a non-governmental resource recipient should be amended to state that the characteristics of a non-governmental resource recipient criterion are not associated with the incurrence of qualifying costs or other qualifying requirements? And the project staff recommends this modification.
Board member responses to question 3? I don't think this should be here based on my prior thing, right? But if we're gonna have these things that are characteristics being its own qualifying requirement, I absolutely agree with the change you made. It's appropriate change. I hope they kind of go away and go into grants and aid, but that's a separate thing. If it stays, I agree with this. Robert.
I agree with the change.
Thanks, Robert. Jackie.
I agreed with the staff change or amendment on this too. Related to this, Pam and Kara and I had a discussion earlier about these non-governmental characteristics, which that whole discussion went to wording and whether you're a recipient or a beneficiary and what the difference is, and talked about, back to question 1, what you were talking about too. So yeah, the wording and how this actually gets conveyed is going to really be pretty important, I think, to our stakeholders. So you're right. We're treading new ground here. We're following new fields when we're doing Cat B on this. So it's going to be interesting to see how this ends up, and even with Cat A on some of these things.
Thanks, Jackie. Chris.
I agree with the recommendation.
Thanks, Chris. Diane.
I agree with the recommendation. And I want to know if Jackie was able to solve who's a beneficiary and who's a recipient, because nobody can ever solve that question.
Thanks, Diane. Jeff.
I agree with question 3, acknowledging all of the discussion we've had and probably will continue to have around it.
Thanks, Jeff. Carolyn stepped out, so we'll get her answer when she comes back.
Okay. The last section of this paper summarizes the board's tentative decisions to date and the project staff recommendations in this paper regarding the recognition unit of account for category B transactions. And the last board discussion question is, does the board have any questions or observations related to the recognition unit of account for category B transactions?
Any board questions or observations that have not been yet discussed this morning? I'm seeing a lot of shaking head no, that they don't have any. Nobody's raising their hands as if they have some. So I think we have provided your thoughts.
All right. And so with that, I will turn it over to Dumara, who's going to take us through paper 3.
Thank you, Pam. And this is the last paper. Now, maybe before lunch. This last paper focuses on the measurement attribute a government should use when it pays a Category A expense with a non-monetary asset. At the high level, the question that this paper is trying to answer is, when a government provides a non-monetary consideration in a Category A expense transaction, should the accounting be based on the recognizing the non-monetary asset as at its existing reporting amount, or should be treated in substance as a disposition measure of fair value, which will involve a recognition of a gain or loss? To answer that question, we consider 2 main anchors. The first one being the prior tentative decisions for non-monetary consideration in revenue transactions and in Category B expense transactions. In that one, the tentative decision was that the measurement attribute was going to be carrying amount. The second anchor is the measurement principle established in existing literature. Specifically, in the intra-entity transfer guidance in Statement 48 that relies on carrying amount rather than remeasurement, and also in the guidance in Statement 72, which provides that the purpose of an asset should be retained for financial reporting purposes, even if the government's usage of the asset changes over time. From the project staff perspective, treating every payment made with a non-investment capital asset as a fair value disposition will move the measurement attribute for this type of transactions away from the long-standing approach established in Statement 48 of no eventuated value through remeasurement when the capital asset is transferred. So consistent with that view, the project staff believes that the suitable measurement attribute is carrying amount. Because as I said, it aligns with Statement 48. It avoids remeasurement of a capital asset at fair value prior to transfer, and therefore does not generate a gain that will not be representative of financial resources received. Now, we acknowledge that if we go with the route of using carrying amount for non-monetary category A expenses, this expense that would be reported may not, if it's reported at carrying amount, it may not align with what the counterparty view as market price. So when the difference is significant, we believe that users may benefit from additional information, and we believe that this concern may be addressed better as a note disclosure. So, for example, the board could consider disclosure requirements to describe that a category A expense transaction paid with a non-monetary asset when the carrying amount and the asset fair value differ significantly. That could be a disclosure requirement if the assessment comes out that is essential. So we in the paper present an example to illustrate how the treatment with carrying amount will look like, and we also present the alternative view of disposing the asset at fair value. But to conclude, we do recommend that the measurement attribute for non-monetary consideration provided for category A expense transactions should be carrying amount because it is consistent with existing guidance and avoids the recognition of gains on assets by using them to pay for an expense. If the board tentatively agreed with that recommendation, we further recommend that circumstances in which the difference between carrying amount and fair value is significant be considered for a potential disclosure requirement to be assessed for essentiality. With that, we will move to question number 1. Does the board believe that the non-monetary consideration provided for category A expense transaction, the measurement attribute should be the carrying amount? And we recommend that approach. And Mary Beth has the task force comments for this question.
A task force member who provided feedback did not agree with the project staff recommendation. That task force member believes that a category A expense is an arm's length transaction and so is not relevant to Statement 48. They also believe that the focus of measuring the transaction is a liability and expense, not the remeasurement of an asset. Finally, they believe that not remeasuring to fair value distorts the impact of the expense transaction on the government and reduces accountability to users of the financial statements.
Thanks, Jamara. And Mary Beth? Jeff?
So I'll give you a break, Joel, not having to go first, right? The more I thought about this, the more troubled I am about it. And so I'll try to give you my jumble of thoughts, and maybe you guys can make sense of them. So where I particularly struggled in the paper was when the staff in a couple places talks about generating a gain that's not representative of the financial resources received. And I note in the actual example that we gave, we say, hey, there's this swimming pool, there's a fee of 150,000, the truck's at 125, has an appraised value of 150. County A will accept the appraised value as payment. They're not accepting the carrying value as payment. So we're acknowledging that what in fact the government is getting is representative of the financial resources they received. That is what they received. They received 150. So I think we sort of acknowledge that by sort of trying to, do this. And I agree, the task force member mentioned, users. And I do think as I, throw my user cap on and say, well, what do I care about? I care about what is the government giving up? And what are they really giving up? Not what is some dated information on their financial statement. And I think we acknowledge that by saying, well, we can, maybe do a disclosure about this and, sort of kick that can down the road. And so I don't know that that's the best way to go, to kick it down the road rather than to deal with it up front, which is to say, now, maybe, and I understand the Statement 48 precedent, and Statement 48 is for intra-entity, and we're outside of intra-entity, right? So I don't feel like I'm beholden to the Statement 48 conclusion. And I try to understand that Statement 40, Statement 48, was it a cost benefit thing? That's why we didn't want to do it, because this whole not representative of financial resources received doesn't make entire sense to me, certainly in a lot of cases. So I don't think I'm stuck with the precedent there. And so I think I would entertain, and now maybe there's a cost benefit thing here, and maybe this decision here, and you guys will educate me, has tentacles that go beyond the decision here, in which case I will try to, take in all that information, right? But as it stands, as I'm thinking about it now, I'm sort of in the world of, this is in a lot of cases representative of what they're receiving. Users do care about the choice. If you're giving away $1 million asset that's marked at 100,000 on your books, I care that you gave away $1 million asset. Why'd you give away $1 million asset? Right. So I think that's information, and I think that acknowledgement, and I think we should contemplate whether that fair valuing should happen up front rather than force them to fair value later on in a potential disclosure. And I think they would have to fair value in order to be able to figure out whether there's a disclosure warranted. So they're going to have to fair value in every case. So I think I'm not getting where the burden thing might be lighter if we genuinely think that this information is important to users. So that's where I'm kind of now leaning more towards disagreeing with the recommendation.
Thanks, Joe. Chris?
So I agree with the staff recommendation, and I still do. I guess, Jeff, for me, maybe it's inherent in some assumptions that I made too, which the staff can check me on this because I didn't include it in my comments as right or wrong. But in going into this, right, we're grounded by a practice that we've already established, which is within that reporting unit, right, that we want to treat them this way. And then we're expanding out to say in all category A transactions. I don't know if it's just practice, but where my mind goes is this makes sense because many, just like the example that we gave of these transactions that we're talking about, even if they're not within the reporting unit, they're within like these related governments, right? And so I don't know that you really, when you take a step back, do you want that distorted with fair value when my state is giving donating this over to a county, or this county is donating it to a school district, or the school district is donating to a city, or whether or not they're in the same financial reporting entity. And so to me, it just made sense to cut out the fluff but then, and not to have the financials impacted by it, but to also put that disclosure because it is important. I didn't see it as kicking the can down the road. I saw it more as offering this outlet to disclose that information to those who might deem it important without, for lack of a better term, like mucking up the financial statements with these fair value numbers, which aren't really reflective of the underlying transaction in a lot of cases. Because one thing that we talk about at this board table all the time is that governments are different, and the nature of those transactions, when they're giving an old hospital building, when they're giving a this or that to another entity, the underlying reason why they're doing it is fundamentally different. And so to fair value that, I feel, is a distortion. And again, maybe it's because I like green eggs and ham now because we've already done it at, within that reporting unit, but that's where I am.
Thanks, Chris. Jackie?
So I agreed with the task force member and Jeff on this one. I don't think that an intra-entity transaction is the same as a transaction between a government and another entity. And even though it's another government, they're still separate reporting entities. They still have separate financial statements. And there's nothing that would preclude this from being a non-other governmental entity. And I do believe that if the school district has given expenses that the county believes are valued at $150,000 based on the appraised value, that's what the expense is. So that's why I agree with the task force member. The expense and liability side need to be properly captured. So because this is an external exchange transaction, not an intra-entity exchange transaction, I agree that it should be valued at what its acquisition value or appraised values or whatever they happen to be, fair values are, rather than at if this was within the same entity, and it's going to wash out in the financial statements anyway. So what difference does it make? To me, they're fundamentally different.
Thanks, Jackie. Robert?
My comments to the staff indicated I would agree with the recommendation. I think I still do. I appreciate the differentiation between the statement 48 intra-entity and the arm's length. I get that. And effectively, if you write up the value of the asset and then you expense it on transferring, you get to the same point in relative to net position. But I also was somewhat, also was mentioned in the paper that this would be, not contravening, but, in terms of concept statement 6, in terms of what's remeasurement more appropriate for. And this is not a financial asset. This is a capital asset. The other thing, and again, we have one example that came up or that was utilized to illustrate this topic in the question. What if school district B, who does the appraisal? County A does the appraisal, and that's what they recognize the asset as. If school district B, if I get the people right here, doesn't do the appraisal, what do they know? If you're sharing the information, and again, even more so if it was a non-government entity, the non-government that was the outside party that was receiving the asset, they may appraise it for something different. And so we should just take their value. I'm still comfortable with the staff recommendation on this.
Thanks, Robert. Diane?
I agree with the staff recommendation. I have a problem with the doing the fair value and then recognizing this gain. And I think Robert provided some really good examples. Chris's arguments about it. I think that it makes sense because that's what's on the books for the government giving up the asset and using that as the payment for the expense. And so I'm good with the staff recommendation, and it is consistent with statement 48. And so I agree with that.
Thanks, Diane. Carolyn?
I agree with the staff recommendation and hearing the counter points from Jeff and Jackie and the task force member. I still do. I agree with, I don't know who mentioned, being uncomfortable with recognizing a gain. But I'm also uncomfortable with that. This is in alignment with, Statement 48 and working, with the district. We did these type of transactions quite often with the city. And I think this is the best way to really capture and communicate what's really happening. So I still do agree with the staff recommendation, even though I definitely hear the counterpoints of my colleagues.
Thanks, Carolyn. Chris?
Just one point there that came out when Carolyn just spoke, and then earlier with Jackie. It's this mention of like whether or not this is an arm's length transaction or not, and it goes to the assumption that I made in my explanation. And I won't say every time. And so, Jackie, I get your point. A lot of times we can be dealing with non-governmental entities or external entities, but the assumption here again, and its assumption is that a lot of times these are not real arm's length transactions, right? It's the city and the school district, and it's these parties where there's some kind of underlying intent or need to support or some other vehicle that's coming in. And so that's also important to consider, in my opinion.
Thanks, Chris. So I agree with the staff recommendation, and Jeff or Jackie, if this helps you any, I'm going to build on probably what Robert and Chris said, because a lot of what they said resonated with me and what went into my decision. But I also think about, Robert started getting into this. It's not a financial asset. We made this determination when we acquired it that it was a capital asset. It had some purpose, it had some use, it had some utility, and we used that utility for some point in time. And now, for whatever reason, we're disposing of it. We're getting rid of it. We're giving it to somebody else. And, this happens with governmental entities, like Chris said, or non-governmental, but there's always some public purpose to it, right? Or almost always. Like if I acquired a piece of land for the purpose of controlling what was developed on it, and then a developer comes with a proposal that I like, and so I just give them that land in order to develop it, it's because whatever it was they decided to develop was what I wanted. It was my economic development purpose as a government. So now I've used it for what its purpose was. And to me, everything else we've done says when we're utilizing this capital asset, we're getting rid of its cost, not its fair value along the way. And so all that even in statement 104, when we meet the criteria to have the capital asset held for sale, we said, well, we're not going to remeasure it. We're not going to redo it. We're just going to keep it at its cost. And all of that kind of leads to, these were capital assets, and we're going to continue along that same capital asset kind of way of accounting for them. And that's what made the most sense to me, and was why I agreed with the staff recommendation. Acknowledging when we get to the next question, users might like to know the difference at that point in time, but we'll get to the next question and the next question. So Jeff, you at least said you were open to hearing what other board members said. I don't know if you gave your final conclusion or.
I think I'll stay where I am.
Sounds right. Anybody else?
Okay.
All right.
Then we're
Tamara?
ready for the next question, which is, given that that the majority of the board tentatively agreed to the measurement attribute being carrying amount, does the board believe that circumstances in which the difference between carrying amount and fair value is significant, this should be included as a potential disclosure requirement to be assessed for essentiality? And the project staff recommends this approach. Maribeth again has some task force comments.
For this question, there are no task force members that expressed feedback on the project staff recommendation.
Thank you both. Board member Diane.
Well, I agreed with the previous one, so I agree with this, and it should be assessed for essentiality. And assuming it's essential, I think it's a good disclosure.
Thanks, Diane. Jackie?
Anticipating that I would lose on the last question. Didn't even realize I was going to have one ally on. I said that I agreed with this because I think that it's at least critical that we provide this much information on the transactions that don't align and aren't symmetrical.
Thanks, Jackie. Carolyn?
And I also agree with the staff recommendation. It should be assessed for essentiality.
Thanks, Carolyn. Chris?
I agree with the recommendation.
Thanks, Chris. Robert?
I agree with the staff recommendation.
Thanks, Robert. Jeff?
I'm with Jackie. I'm not going to cut off my nose to spite my face, and so I will agree with this recommendation.
Thanks, Jeff. I can understand the utility of this, so I'm in agreement that we put it on the list of note disclosures that we would ultimately maybe research surrounding this project for essentiality.
All right, I think that's everybody, and that is our last paper we have for you today. We're working on some more measurement papers for next month. One related to the allocation of variable consideration and some other topics. We're also planning to bring to the board some results from some research we've done on the availability period. So looking forward to that discussion next time.
Thanks, Pam. Appreciate you and the team's work here. Appreciate you thinking about and potentially considering and bringing something back to us based on my thoughts on some of the issues we talked about. So I appreciate that extra effort and hopes to just get this as good as we can get it. So appreciate all that. Look forward to next board meeting. With that, it is roughly 11:30. It would seem pretty, it wouldn't make a lot of sense to start going concern and then stop, 15 minutes in-ish. So I'm going to suggest that we break for lunch, understanding the lunch probably isn't ready yet, right? So maybe that's 11:45, plus we got to take a staff picture or something as well. So let's take a little bit of a longer lunch period and come back at 12:45. Is that reasonable?
Yes, because lunch is probably not ready right now, and yes, we have to take a picture, so yeah,
Okay.
it makes sense.
Let's come back at 12:45 and we'll start going concern then. Thanks, everybody. All right, welcome back, everybody. Hope everybody had a good lunch. Got through revenue and expense recognition this morning, number of papers, and we are changing now to our going concern severe financial stress project. Deborah, I'll turn it to you to start us off here.
Thank you. Good afternoon, everyone. Today, we are continuing the redeliberations on the severe financial stress part of this project, and specifically talking further details about the requirement to make severe financial stress disclosures. And so we have 3 papers for you today related to those topics. The first one is about the timing of the assessment. And paper 1 has 2 sections to it. There's one section that is about analyzing the timing of the current condition parts of the disclosure requirement. That is a government that is insolvent or is in very poor financial condition. That part is redeliberations from the preliminary views, which propose that an assessment of whether a government is insolvent or near insolvency would be done as of the financial statement date. And so that is the first section of the paper. The second section of the paper is then looking at the timing of the forward-looking assessment, which was not part of the proposals in the preliminary views, but which the board added to the disclosure requirement back in March. So based on the initial feedback from board members, the board's tentative decision on question 3 of this paper might influence how some members are going to vote on question 1. And so we are going to go a little bit out of order from the paper. We are going to start with question 3 and then come back to questions 1 and 2. And I will turn it over to Eniola to start that discussion.
Thank you, Deborah. We will begin by discussing an assessment as of the date the financial statements are available to be issued. Some stakeholders supported requiring an SFS assessment as of the date the financial statements are available to be issued for more current information. They noted that the lag between the financial statement date and the issuance date could create an information gap if a government's condition changes during that time. However, the project staff have both theoretical and practical concerns with this assessment date. The project staff believes that financial statements and the notes thereto are intended to report a government's financial condition as of and for a specific period, not to provide real-time information as of issuance. While certain subsequent events are disclosed in notes to the financial statements, the project staff believe that those disclosures are intended to provide context for the financial statements rather than update users on current condition. There are also practical concerns about a government's ability to obtain reliable information as of the issuance date, the potential for delaying issuance, and the added burden of requiring separate assessments as of both the financial statement date and the issuance date. The project staff believes that some of the more current information sought by users could be provided through the forward-looking assessment to insolvency. Therefore, the project staff recommends that government should not be required to assess whether they are insolvent or in very poor financial condition as of the date the financial statements are available to be issued. Task force members with preparer and auditor backgrounds who provided input agreed with this recommendation, and a task force member with a user background noted that the forward-looking assessment may provide sufficient information. And so I will pose board discussion question number 3. Should governments be required to assess whether they are insolvent or in very poor financial condition as of the date the financial statements are available to be issued? The project staff recommends that government should not be required to assess whether they were insolvent or in very poor financial condition as of the date the financial statements are available to be issued.
Thanks, Eniola. Jeff?
So I guess I'll start here, and I appreciate, I guess we're starting with question 3 as opposed to question 1, but you'll see there's plenty of overlap between my discussions of this question and question 1. So, and there's a lot of different things sort of rattling around in my brain as I think about this, and so I'll try to go through them to sort of see how I turn out. So we're dealing with these 2 assessment dates, year end and then date of issuance. And as I thought about and reviewed the feedback we received to the PV, right, there were plenty of users who said the date of year end was too late. And I know that that makes sense to me. That resonates with me. You know, when you're dealing with a financial statement that's 6 to 9 months old, and now you're dealing with a judgment that's 6 to 9 months old, how useful is it to users? How useful is that information? We heard, or we talked about the burden to governments of looking at it as of the financial, the date of issuance. I was kind of surprised. We heard some feedback that that's true. They agreed with our view, but we heard feedback that that was not the case. And in fact, the feedback I heard was not as loud as I thought it would be. And there were auditors and governments who said, pointed out that this is a condition that is pretty severe and that governments should be aware of what's going on, right, when they're assessing it, and should be able to make these assessments as of the date of issuance. I think when I think about this choice that I'm given between Q3 and Q1, one of the things I think we also heard a lot from users is this notion of the latest information, right? But I want to be clear that I'm viewing this as a choice, right? Because in our prior discussions, we had some discussion of like, should we have them do the assessment twice? You know, do it as of the financial statement date and then do it again as of the date of issuance. And to me, there's some parallels there, like, and I think the staff paper pointed out, like you could have a situation where you were in it year end, and then by date of issuance, you're out of it. But you still give the disclosure. But that to me is tantamount to question 2, which is like, were you in it during the period and now you're out of it as of the financial statement date? And I think the sentiment has been, no, you don't give a disclosure because you're out. And pulling on that thread, why are you doing that? Because the latest information is the most valuable, in my view. And so that's why I would view it as it's not, you know, it's not, but I want to point out it's not invalid information. I think there are plenty of users, if you were to query them and say, hey, they were in it, but then they got out. Do you want to know why they got out? Yeah, I want to know why they got out, right? But I'm recognizing I'm making a choice here because I don't, unless the board has an appetite for this, let's have them make it at 2 different dates, which I'd be surprised if you guys do, but I'll be open to it. But if I'm given a choice, I want to go with the choice that's the latest information, right? That gives the latest information, which I think we heard from users was desired. I think we heard from enough preparers and auditors that that's doable. And so I believe that requiring this judgment to be made one time as of the date of issuance is my preferred outcome.
Thanks, Jeff. Diane.
So I'm going to approach this a little different than Jeff, but I think I come to the same conclusion. So I do believe that the government should make this assessment as of the dates the financial statements are available to issue. I did this sequentially. So I was okay with making the assessment as of the financial statement date and then got to this as kind of a, okay, and we just want to add that this is where we're at as of the date the statements are available to be released. Thinking about this from the standpoint of a preparer, which I have been, I was thinking if I made this whole assessment as of the financial statement date, I know exactly which indicators I am triggering at that point, where my government is, and what the problems are. So taking that another 6 months down the road and looking at those indicators and what's changed, it's not that much more work to do that. It's not like starting over again. You're going to know if things have changed with those indicators in that 6-month period before the audit comes out. So I don't believe it's that much trouble. Now, it's not going to change my opinion, but I may think through this a little differently if we decide they don't have to make the assessment as of the financial statement date, because then you're going to do all of the work as of this date, but I'm still okay with that. I think there's enough things that the preparers are going to be aware of what's going on with their governments and what's happening in that whole period of time that they could still, if we decide that it's only going to be this date, they could still make that assessment. So I am in the same camp with Jeff. I also disagree with staff.
Thanks, Diane. Chris.
So I'm on the other side. I agree with the staff recommendation. And the reason being is that I did think that it would be a substantial lift. When I think about making an assessment as of the financial statement date, you are informed by all of the information, the heaps and mounds of information that you pull together to support your financial statements. And I do understand what Diane is saying, but concerns around logistics. I mean, how many times have we been in positions as preparers where we think we're going to go as of this date, and then now it's a month later because some significant component unit is not ready for us at the time, and we got to wait for their financials to be issued or close to issuance or whatever the case might be. and the amount of work that it takes in a disaggregated government. Maybe it's different for a small government, but for a disaggregated government, there's so much work that's involved to perform, and this is the key for me, an assessment. And that's where I go to. So earlier we talked about not unreasonable, and in my mind, at least, if we're performing an assessment, not like a down a date, not like a representation that nothing has significantly changed from the point of the financial statement date that I'm aware of as the person and the preparer that's putting this together, that would make me say or attest to our condition changing. I think that's fundamentally different. But if we're talking about an assessment and doing an assessment at year end, then my expectation as a preparer and an auditor would be the same energy you put into year end is the same energy that you need to put into that assessment as of that available to be issued date. And that's the hurdle that in my mind, I can't get over, that same amount of energy. Again, if we're talking about some kind of roll for, I don't know what it is, but something to a lesser degree anchored in all of the information that you reviewed and compiled as part of the financial statement date, then maybe I could get along with that. When we're talking about doing that, in my mind, again, essentially, that's where I struggle. So I disagree with the staff recommendation.
Thanks, Chris. Robert?
I also agree with the staff recommendation for many of the reasons Chris just expressed, particularly, I mean, if you're a smaller entity, I would agree it's probably not that difficult and it's probably not that far off. But if you're a larger, more complex entity and you have, reporting entity issues, you have multiple component units. I mean, a state government, I'll just use state government versus a smaller local government. I think it could be extremely burdensome for them to make the assessment on both times. I also appreciate the staff's, bringing forward the theoretical concerns on this. I don't think the financial statements are one piece of information that users use, but it's not the only piece of information. And under the concept statement, I mean, we can't be all things to all people, and so trying to do that, by doing it at both dates, particularly with the potential for the burden that we've talked about, I struggle with. I do think, though, that as the one task force member indicated, from the user perspective, that as we get into the conversation and deliberation on forward-looking assessment, that might provide some additional information that they could very well find as useful as doing this on both dates.
Thanks, Robert.
But I think that view of doing it on both states, that's presupposing our answer to Q1. I just want to point out, like, the choice on the table here is not do 2 or do 1. It's Q1 is up in the air, right? It's doing this one and not Q1, not doing this one and Q1.
I guess,
right?
Jeff, to your point, though, at least in my mind, all the information, you have to go through compiling all the information for Q1. You have to do that regardless, right? You have to do that to issue your financial statements. So to me, that's already a done deal. Whether or not you say it or not, you basically have to look at and review all the information that'll get there. Whether you make the statement, you're essentially, to me at least, you do enough there to make an assessment. To Diane's point, you've dug enough into those problematic areas. So to me, at least in my mind, I do see it as a and for both, because I don't see how you can get out of not doing it as of the financial statement date, not doing the work.
Yeah, no, I understand the point of doing the work, right, and creating the financial statements, right? But if you think about what our example indicators are about, they're not about your fund balance is 10% negative, or your, it's not, those example indicators are not grounded necessarily in the specifics of the financial statements. They're talking about a sequence of things, of happenings that are you having to refinance debt? That's not June 30th specific phenomenon, right? I understand it's going to be informed. So the way I view it, Chris, is I don't view you having to, nor am I asking for the government to recreate the financial statements. as of the date of the issuance in order to be able to make this determination. You're going to take the work you did to create your financial statements. You're going to take the additional information that appears subsequent to that. You're going to look at these example indicators and to make your assessment of, do I feel I'm in severe financial stress in accordance with how this thing is described, or don't I? Right? So I don't really view it as twice the work. I view it as you're doing it one time with the inputs that you have as of the date of issuance.
Carolyn.
I tentatively disagree with the staff recommendation because of the extreme lag time that is prevalent in governments between the financial statement date and the date financial statements are issued. I support requiring governments to assess if they were insolvent or in very poor condition as of the date the financial statements are available to be issued. I agree with the stakeholder sentiment that a government may not meet those conditions at the financial statement date, but facts and circumstances could change before the financial statement issuance date, and they are insolvent or in very poor financial condition at that point. Because of the severest consequences to governments and those that they serve, and I know we'll get to this, but being in the condition is more definitive, in my opinion, than the proposed forward-looking assessment. I support the disclosure currently. I support the disclosure at the financial statement date and a review during the time when the financial statements are available to be issued. And then I said I look forward to deliberations. So.
Okay. Just to clarify that though, Carolyn, a review is not on the table. What is on the table is an assessment as of issuance. So you said a slightly different word, which was kind of what Chris was hinting at a minute ago. She was saying review as of issuance, right, which is not exactly the same thing as an assessment as of issuance. So like question 3 is just, do you want to assess it as of issuance?
Yes.
Okay, fair enough.
Jackie.
I agreed with the staff recommendation. When we started out with this, I agreed with what we were thinking of, what we were looking at. It was supposed to be an assessment of what was reflected in the financial statements so that the users could have a better understanding of what the financial information was being said to them. And I believe that to do that, it needs to be done as of the financial statement date. It's based on the information that's reflected in the financial statements, that's audited, captured by their transactions, and management is providing their assessment of that. Subsequent to that, that's not what it is. It's based on additional information that's not necessarily in the financial statements or reflected in the financial statements. So it's a different kind of analysis. And I do agree that if we're talking about an assessment, it's a higher order than a review. And I do think that that will add time and complexity. As Robert points out, the more complex the entity, the more difficult it becomes to do this kind of assessment and still get your financial statements out 6 months or 9 months after the fact. It'll probably end up being a year to 18 months based on how long it's taking to get through audits right now. So I think it should be as of the financial statement. I agree with the staff.
Thanks, Jackie. So heading into the PV, I supported doing the assessment and condition as of year end. I felt a little like Chris and Jackie have described that, you've got accumulate a lot of information. It's kind of a big deal. It's going to be really hard to do that at year end. I would say the feedback, and I really tried to pay attention to this, the feedback I heard from preparers and auditors and comment letters and in the public forums was mixed. I heard a number of them agree with that's too hard to do at year end. I heard a number of them, more than I probably thought I would have, say, oh, we could do that at year end. And so if it's, 50-50, I kind of get in this camp of I have kind of moved over into this camp of Diane and Jeff, where we're not asking you to recast the whole financial statements in order to do the assessment. And I should preface all this by, number one, most governments aren't going to have this disclosure. They're not in severe financial stress. And of the governments that end up being in severe financial stress, or at least having to assess whether or not they are, the difference between year end and available to be issued isn't that significant. Like they don't change their financial condition that quickly. Now, we do have to acknowledge, I could come up with circumstances where it might could happen. We asked GASAC that last meeting. They gave some examples. So we have to think about it being able to happen. But given that I still don't think that's the majority of the cases, I think governments are more likely, kind of like Jeff talked about, they're able to take the financial information they've accumulated and it's been audited as of year end, understand, which they have to do anyway with subsequent event period reviews, understand the major things that have happened and be able to take that into account using year-end information to be able to make this assessment, which isn't specific indicators. It's not, as Jeff pointed out, it's not, are you at X percent of whatever. It's a judgment call. I think based on what I've heard and kind of how I feel about it, I believe governments would be able to do that. And so I would, and because I agree, it provides more current information for the user, where Jeff and Diane and Carolyn are, that I would say, I would disagree with the staff and believe they should do the assessment as of available to be issued. Any other discussion? It's 4-3, I guess. And now we'll decide whether to do Q1 or not. Question 1, year end or not?
We will do Q1. What the answer to Q1
Yes.
is, we will see.
That's what we'll
So
see.
I'll give it back to
Yes.
Aniela.
Thank you. Next, we will discuss an assessment as of the financial statement date. Assessing whether a government is insolvent or in very poor financial condition as of the financial statement date would provide context to the amounts reported in the financial statements and would be consistent with the purpose of notes to financial statements as described by concept statement number 7, which describes notes as information that supplements the financial statements. Additionally, as proposed in the PV, an assessment as of the financial statement date would consider subsequent events information that relates to conditions existing as of that date, even if the information becomes known after year end. Some stakeholders agreed with this approach, while others did not, and we heard similar feedback from public forum participants. The primary concern was that an assessment as of the financial statement date alone may be too limiting and may not capture governments that enter very poor financial condition after year end. Based on the feedback, the project staff believe stakeholders seeking assessments during the period or as of issuance generally want those assessments in addition to, rather than instead of, an assessment as of the financial statement date. For example, if the financial statements show very poor financial condition as of the financial statement date, but the condition improves before issuance date, the project staff believes that those stakeholders would still want the SFS disclosures to explain the condition evident in the financial statements. Therefore, the project staff continues to recommend an assessment as of the financial statement date. Task force members who provided feedback agreed with the staff recommendation. I'll now pose board discussion question 1. Should governments be required to assess whether they are insolvent or in very poor financial condition as of the financial statement date? The project staff recommends that governments should be required to assess whether they were insolvent or in very poor financial condition as of the financial statement date.
Thank you, Aniela. Question 1, Jeff.
Can I just ask a question just to make sure as we think about this? Because now we've reversed the sequence here. Now the facts on the ground have changed. So I just want to posit, make sure as we think about this. So given our response to question 3, if we're in a world now where one were to answer yes to this question, and the answer for a particular government was, I was in it at year end, and I do it at issuance date, and I'm not. Are we saying that's going to give you a disclosure? In other words, because you were in it at one of these two periods, you've got to give the disclosure, right? And if you think that, then you look, why is that? Then think about question 2, like you were in it during the period, but you're out of it as of the year end date. Why would you be against that? If your argument is the user wants to know, I believe the user wants to know why you're out of it, then as you think about Q2, then what if you were in it during the period and you got out of it by the year end date? Presumably you would say the user wants to know that too, because the users, well, we may be lots of things, we try to be consistent, right? That we would want the same information in 2 different scenarios. So just as I think through that, I think the answer has to be, now that we have this issuance date analysis, how would you feel if you were in it at year end and out of it by issuance date?
Thanks, Joe. Yes, Deborah.
I think one difference might be if you're looking at financial statement date and issuance date, those are just 2 dates. Whereas during the period, unless we specified only like, a certain time, like that is an entire year's worth of dates to consider. And so there's a potential, I think the cost benefit kind of grows when you're looking at that.
Perhaps, but in theory, if you're hitting it as of a date during the period, that date to year end versus year end to issuance date or date to
But
date.
you have to assess every date to see if you were there. And
That makes sense, Deborah. I mean, I understand what Jeff's saying. There's validity there, but it also isn't also exactly the same thing as Deborah points out. Makes sense. Anything else, Deborah?
Joel, the other thing that is relevant though is given what y'all just decided on question 3, the majority of people want it assessed as of the available issue date. If a majority of people also say they want to assess it at year end, you just decided to assess it twice.
Sure.
So you have to think about that in terms of how you want to answer question 1 now, knowing you're going to do it when it's available to issue. So do you want to do it twice?
Understand. Diane.
Okay, so in my perfect world, I would say that I want an assessment done as of the financial statement date and an update as of the date the financial statements are available. What? No, I know we've already voted to do an assessment on question 3. I'm talking my perfect world. That's right. But,
A question ago, Diane.
no, sorry. That would be my perfect world. So I would suggest that I would vote yes on this, that I agree with staff for the financial statement date. With a caveat, I would go back and change question number 3 to be an update instead of an assessment. That's my vote.
Diane has posited a 1A, I guess.
That's right.
Chris.
So that's where I was on the last cue, right? I said like an assessment, and that would have changed it to 4-3, Diane, just saying. If you would, but that, so under no circumstance do I think that we should be requiring 2 assessments, because that's just problematic. If I'm attacking it from a preparer, if I'm attacking it from an auditor standpoint, I say, show me what entails your assessment as of this date, and you show me the same thing as of this date. We can say this and that I think that the expectation would be, if it's an assessment, the assessment needs to be the same. The paper, the evaluation, whatever you produce needs to be consistent. And so whether it's a 1A, if that's an option, to Diane's, which is what I wanted from the start, or I would, even though I know it's detrimental to not have one as of the financial statement date, and I completely understand everything the staff said, I would not want 2 under any circumstance. So it's either we don't get one as of the financial statement date, even though I understand how fundamentally flawed that is, or we get one at the financial statement date, and then you roll forward, review, attest to whatever you need to attest to as of the issuance date, which I'm completely okay with.
Thanks, Chris.
So can I just ask, we're placing a lot of stock in the difference between assessment, review, update, right? And I'm just trying to figure out in my own brain, right, like how am I supposed to think about the difference from that, all right? Like if my goal is to get the latest information by doing it as of the issuance date, am I getting that? In Diane's perfect world, like, am I getting that? I don't see how I'm not, but maybe I'm missing something like, oh, well, update is not is not assessment, so there's something's going to slide through, right? That's not going to happen. But if it's, if you update, what if you weren't in it at year end, but you update yourself to be in it at issuance date? Can that happen in your perfect world?
Well, okay, in my perfect world, though, that assessment is you've gone through all the indicators, you've gone through even some that, might not be on the list. You've narrowed down where the risks are for your government. You know that this is putting you in SFS as of the financial statement date. Okay, so to me, an update is, okay, I'm following these things that I assess to be my biggest risk over that next 6 months until the audit's ready to be issued. But if there's something else that comes up, I'm going to factor that in, but I'm not going through the entire list because there's a whole bunch of things that don't even apply. So that's what I would eliminate in that second assessment. We're going to focus on the things that we know are risks and anything that we've seen come up in that next 6 months until the audit comes out.
Would it be, Diane, would it be that because part of me hears you saying like, okay, government makes determination as of year end, and what they're doing in this update is just, if the answer was yes, updating that it's still yes, as opposed to it was no and updating it to yes. Do you see both of those as equally valid, or is it the yes, confirming the yes, but not changing the no?
No, I see both of those because I think that's important to users is, okay, that's one of the big things. Has this changed? And so I think that's really important. But I think that in that initial assessment, you can narrow down where the risks are for your government. And even if you're at a state level, think of how big these items would have to be, these indicators would have to be to trigger SFS for a state. I mean, it's going to have to be something huge. So I think it's doable. And an update, you're following these anyway, especially if you say, yeah, I'm in SFS as of the financial statement date, then you're following it real close because you want to see enough change that you could actually come back and go, yeah, no, not so much. But you still have to do that disclosure. In my perfect world, you would still do the financial statement date disclosure because then you're telling the users after that, okay, as of the date the financial statements are ready to be released, then we have changed things.
Robert.
So although I agreed with the staff recommendation on question 3, I understand the points that the majority raised. And I go back to a comment that Joel made about that these disclosures likely will apply to a very small number of governmental entities. And those that SFS disclosures will apply to, and if I recall correctly, we haven't re-examined the example indicators, so but I'm reading it from the PV and I'm going, I did agree with the comment about likely you'd have overlap on if you're doing two assessments, and whether we call it an assessment or an update or whatever. The likelihood if a government is exhibiting these example indicators as of the financial statement date, I find it hard to believe that they're miraculously going to come out of it within 6 to 9 months. Now, maybe if it's 12 to 18 months because they're trying to work things out, potentially. But I think the reality is, again, even though I agreed with the recommendation on question 3, is they're going to be doing this almost at the same time. And as a result, I'm not sure that there's really an update that's needed, particularly if the example indicators are leading government to truly examine whether they need to make SFS disclosures. They're doing it as the financial statement date. Their auditors are going to be asking them to do it as of that date to make that assertion, or whether it's an appropriate disclosure as of the date of issuance, if it's that bad. And so I'm not sure we need a 1A because I think it's, for practical purposes, it's going to be happening at the same time. I can agree with Chris. I don't want to do 2 full-blown assessments, which may be necessary for larger, more complex entities. I recognize that. But I mean, I agree with the recommendation in question 1 because and I did from the get-go, and because I thought that was the appropriate date. If the board TBD is to go the other direction, sit there and live with it. But I think practically it's not going to be that big of a distinction.
So to be clear, you don't want to do the assessment as of year end based on the fact that the board decided to do it as of available to be issued. You don't want to do it twice.
I don't want to do it twice, but I think practically you're going to be doing it as of year end. I mean, you're not going to be doing one on a calendar year end. You're not going to be doing this on January 31st. And if your financial statements are available to be issued on June 15th, I think you're going to be doing it on June 14th or June 1st, something like that. You're not going to be doing one on January 31st. That's my practical viewpoint. But I think 1 is better than 2.
Thank you, Robert. Chris.
So like, just to explore that, there's certain information that's just not going to be like accrual information, right? Like, so we're talking about obligations as they become due. Who's doing the work? Again, if we're talking assessment to assessment, that accrual information that takes forever to aggregate in a government, you don't have that as of that interim period of time because governments aren't built for that. So I think, again, it's an acknowledgement that while in my head, I'd love to say that it's a shorter period of time and all of those other things, it's by design inconsistent. The things that you can look at as of a fiscal year end, when let's even talk about a government, right? You know how hard we have to work in the comptroller's office to get everybody's heads out of their butts and get our financials in order for year end, right? Just to close down things, pay invoices, all of those things. Now we're looking at it as of a point without getting the information where you're not doing that. So I just think assessment, like, I just want to just continue to beat that drum. An assessment twice is a consistent assessment, because if I'm coming in and I'm writing the opinion and my name's on the line, I'm going to say, show me 2 versions of this, a 630 and a 1228 or whenever you issued, and or available to be issued. And I just don't know that you'd be able to do it at the level both times. And that's the biggest concern that I have right now.
Jackie.
So because we flipped on 3 from where I was, I'm flipping on 1 because I believe 1 assessment is sufficient.
Thanks, Jackie. To the point. Carolyn.
I have originally agreed with the staff recommendation. because I really did not think that I was going to be successful in my disagreement in 3. I really, if there's, I really would just like I would be in support of just one assessment. And that would be at the date that the financial statements are available to be issued. I don't want to rehash as far as something less happening at one point in time. But hearing this conversation, I think asking governments to do 2 full-blown assessments is a bit much. So that's where I'm at.
Thanks, Carolyn. Chris, your mic is on. Did you want
Oh.
to speak or you're okay? Just making sure. Jeff?
Yeah, so the tenor of this conversation was along the lines of the way I thought it would turn out when I was thinking about Q3. So that's where when I'm given the choice now, because doing 2 is too much. And that's where I was like, I think Q1 financial year-end date has validity for lots of users. I just think that if I have to make a choice, and I made the choice that I made in Q3, I think that's with the most current information that on balance is the best choice. And therefore, I'm willing to disagree here, say, go with the belief that I think it's true. I don't think it needs to be a full-blown assessment each time. I think you're going to take your indicators and apply them to the facts you have as of that date, which includes your audited financials and other things, and do that assessment one time. So I will disagree.
Thanks, Jeff. So I disagree with the staff recommendation. I think about it a lot like Robert's still, and so I've been trying to mull Diane's 1A, and I just don't. Every time I couldn't get my brain out of at least the way you described it, or thinking about how it plays out, like a pension measurement that gets updated, which is still an estimate, but almost seems to indicate that there's more precision in the judgment utilized here than I think is actually going to play out, which is kind of what Robert was getting to, of you're going to look at these indicators broadly. It's not a numerical calculation, and the difference between year end and available issue in most cases probably isn't that great. And if it is, and something unusual happens, then you're going to just be able to take that into account, because I don't view it as forcing the government to come up with all their APs again, because I don't think if you had your APs at year end, either they're causing you problems, like somebody that's a year behind in making payments, and that whether or not that's changed in the 6 months since year end, or it's not the APs that's causing you problems, it's the bigger pension liabilities that you're not funding and the revenue. I don't think that what we're talking about, the scale of what you're talking about being in severe financial stress, the APs, the difference from year end to whatever isn't going to change your assessment. So I don't think that's what we're asking governments to do. And I tend to agree. I think it'll be more straightforward to people to just do it once, whether or not there's really that big of an effort to do it twice. I just think it will be less complicated, more simple. And so I would prefer to just do it once as well, which is why I disagree with this one based on our answer to question 3.
Just to make sure I have the votes accurate, Diane and Chris, were you still with the staff recommendation, or
No, I was not.
no?
It's just me in my perfect world.
You may have had it, Diane, if you just, on that other question.
Question 2.
Yes. We'll now discuss an assessment of insolvency and poor financial condition during the financial reporting period. As discussed in the PV, requiring SFS disclosures when a government is near or at insolvency during the reporting period, but not as of the financial statement date, presents significant practical challenges for governments. Some stakeholders express preference for an assessment during the reporting period, noting that it could provide additional insight into how governments enter and elevate SFS conditions. While the project staff acknowledges the potential informational value, we believe that requiring governments to assess insolvency or very poor financial condition at multiple points during the period would be overly burdensome and difficult to audit. Accordingly, the project staff recommends that governments should not be required to assess whether they were insolvent or in very poor financial condition during the reporting period. Task force members who provided feedback agreed with this recommendation. Question 2. Should governments be required to assess whether they are insolvent or in very poor financial condition during the financial reporting period? The project staff recommends that governments should not be required to assess whether they were insolvent or in very poor financial condition during the financial reporting period.
Thanks, Eniola. Board member responses here. I think this was going to be the hard one.
It's gonna be a tough
Robert.
one. I agree with the staff recommendation.
Thanks, Robert. Diane?
I agree with the staff recommendation.
Thanks. No 1A, no 2A. Thanks, Diane. Jackie?
I also agreed with the staff recommendation.
Thanks, Jackie. Carolyn?
I agree with the staff recommendation.
Thanks, Carolyn. Chris?
I agree with the recommendation.
Jeff?
So trying to be consistent, you may disagree with him, but at least he's consistent, right? Like, so following through on my mantra of the latest and the most current information, right? And following through that thread, pulling that thread here, I will agree with the recommendation here because I'm relying on the most current information.
Thanks, Jeff. I agree with the staff recommendation as well for the reasons we talked about in the last question, although even more so here, more cost, as Deborah pointed out.
All right, thank you. So that concludes the first section of paper 1 about the current condition. Now we're going to look at the timing of the forward-looking assessment, and Roberta will take us through that section.
Okay, thank you, Deborah. And just to remind everyone about what this forward-looking assessment component is, it is something that was a new topic that was added. That was not something that was included in the preliminary views. It is represented by the second yellow car in that cars going over the cliff or heading toward the cliff or just circling near diagram that was included in the paper again for you. So so that car is not currently in very poor financial condition, but is expected to be insolvent within a certain time frame. So it's the second yellow car, but it's not the first yellow car. The first yellow car is in very poor financial condition, and so it's covered by our previous discussion. The timing of this assessment doesn't need to be the same as the timing of governments in very poor financial condition because it's not about a government's current condition however, it's about a future condition. It's about insolvency from a period of time, from a point in time that you're being selected. So it's about information in advance of a condition rather than a current condition. However, I guess I suppose it could be the same period of time. Another thing to note about this is the relationship, and I think it's kind of been brought up a little bit earlier, is the relationship with Concept Statement 7 and the use of forward-looking information. At this point, we are still talking about the criteria of when a disclosure will be required, not the specific content of a disclosure. So that's a pretty critical difference in there, that forward-looking information is not appropriate for the content of a disclosure, but can be used as an input for determining whether a disclosure is required. So at this point, we're still consistent with it, but that's something that we do need to keep in mind as we proceed and we have future deliberations on this topic. So the periods to be considered again is period end. We talk about an assessment of period end possibly could be more objective. You have more objective financial data because you have a good cutoff and that sort of information. There is potential at that period of time for government maybe to delay issuance, to demonstrate that it doesn't become insolvent in this period of time that to be selected. There's also a concern if the assessment is made at period end, if there is a delay in issuance, how much of a remaining look forward period is left at this period of time. It can vary depending on how long it takes the government to issue. Some governments, maybe some BTAs issue as early as 2 or 3 months. Then you've got the larger governments typically take longer. So if it's measured from the date of the financial statement, you have a varying remaining look forward period. And it could be a small, like for a government that issues 6 months after year end. If we had, for example, a 12-month look forward, there'd only be 3 remaining look forward months. So it would provide less information. When it came to making a look forward assessment during the period or at some point during the period, it just didn't seem to be consistent with the idea of this forward-looking assessment. So we really didn't think of that as some logical thing to be processing through this. The other logical period of time, of course, is the date the financial statements are available to be issued. This is the date that the FASB uses for an assessment of whether entities are able to meet obligations. And for those entities, apparently this assessment is able to be made in the private sector environment. Now, the governmental environment may or may not have consistencies with that. There may be something different about the nature of our governments that it may be more challenging for that, or for some governments, it may be more challenging. There can be different kind of incentives at this point. For example, there could be incentives to delay issuing to provide time to take certain actions that may prevent something from happening. For example, doing some kind of debt restructuring or something like that. So there can be incentives in both times, maybe different assessments. It would be consistent with the timing of 102 assessments. That was something that was raised by task force members. It would provide the most up-to-date information, obviously, as we're talking about with the current condition assessments, that doing it at the date the financial statements are available to be issued. That's something that we have certainly heard in our feedback, is that these type of information disclosures, the more current they are, the more interested that they are in having them. And this is the alternative that task force members supported when they were providing feedback to us. So with that, I'll ask question 4. Should governments be required to make a forward-looking assessment to insolvency as of the date of the financial statements, or as of the date the financial statements are available to be issued? And our project staff recommendation is that governments be required to make the forward-looking assessment to insolvency as of the date the financial statements are available to be issued.
Thanks, Roberta. Remember responses to question 4. Jeff?
So I'm going to follow my same theme here, right? Of one of the things which the staff paper points out is this idea of the most current information, like Roberta said. And so because we're in a world where we do have this delay in issuance, right? So I know we're going to get to what that length of period is in the next paper, but whatever length of period, say it's 12 months, and now you're 9 months in, how much is the user getting out of that thing of 3 months? Or, you know, some much shorter period. So I think the most compelling thing for me is the most current information. I think the fact that this would be consistent with the way just went through the other evaluation, I think is a benefit as well, not the driving benefit, but therefore I agree with the recommendation.
Thanks, Jeff. Chris?
So I hope I don't get my hand slapped for this one, but I viewed this one in connection with the probability assessment, because to me, that's what gets me over this hump. Not that you're making it, but that and making an assessment, but that you're making an assessment to a certain probability level, that if it's, you know, I think that there's a high probability essentially that we're going to get there. I'm okay with, you know, I'm okay with that and making sure that that's packaged together. So I agreed with the recommendation. But I mean, you guys heard the conversation when we deliberated last time. For me, it's this probability assessment that makes me get more comfortable with that forward-looking statement.
Thanks, Chris. Robert?
I agree with the staff recommendation as well. I think to some extent, even though it's not specifically talking about the exact same thing, it's obviously related in the context of this project. Consistency and with the prior decision on the disclosure being as of the issuance date, having the look forward being as of the issuance date, there's some congruity there. That just makes sense to me and may not be a theoretically correct answer. But the other thing is the consistency with Statement 102 in terms of the timing on when you would do this. If there were disclosures you had to make, government would have to consider under Statement 102. So I agree with the staff recommendation.
Thanks, Robert. Diane?
I agree with the staff recommendation, and on the consistency line of thinking that Robert was talking about, also the consistency of the time frame, because of governments issuing their audits or their final financial statements at different times from the financial statement date. I like the consistency that they would all be as of the date the financial statements are available to be issued, and it's also consistent with the FASB guidance.
Thanks, Diane. Carolyn?
I agree with the staff recommendation. The time frame lines up with what we previously voted on in question 3 rather. So I basically, agree with the staff recommendation and the time frame that they're suggesting.
Thanks, Carolyn. Jackie?
So I disagreed with the staff recommendation because I disagreed with question 3. Now, because we've gone with question 3, having a look forward from the financial statement date that goes 9 months out when we're going to actually doing the assessment related to question 3 means that having that as of the financial statement date really doesn't make any sense anymore. So my disagreeing has no value at this point in time because of what we decided on question 3. No sense having a look forward period that's going to actually be covered by the real assessment type of a thing. So I'm still not really happy with question 3, so I'm going to continue to disagree.
Thanks, Jackie. I agree with the staff recommendation here. I think this is one of the more important parts of what we're doing. I think this will contribute to the disclosures in this project. And I think that doing it from the date the financial statements are available to be issued makes the most sense, especially in light of the decisions we made in the prior questions.
Can I just ask a question, I guess, so we can, I think this is the place to ask it, only because I don't think the other papers, but as Roberta pointed out with our visual, right? The visual of the car that we've added for this thing is an entity not in severe financial stress. Right. So I guess when we think about it, I guess, Deborah, this will happen when we talk about the indicators, or maybe the disclosures, the indicators and the disclosures, which I guess is forthcoming. Right. But what disclosure does that additional car give? Right. Heretofore, I've been thinking about it as a SFS disclosure, right? Thinking that the entities are going to give this disclosure are in SFS. Technically speaking, or visually speaking, they're not in SFS, right? Now we have to potentially change something, whether that's an indicator or change a disclosure, in order to make it relevant to that fourth car, which is sort of a unique individual, right? And so I guess we'll have to think about that as we embark on what those indicators and or disclosures will be and will mean, especially as it relates to that fourth car.
But Jeff, you can get into a world where there is no fourth car anymore. You've synced the dates up, and so now simply by doing the assessment at the same moment you do the indicators, if they fail the assessment, that's almost quasi a super indicator, which says they are in severe financial stress. So you can get to a point where there is no fourth car.
Well, it's what's interesting, right? And I'm interested to see what staff says, but it becomes like, well, we can do whatever we want. We set the rules, right? Like, but it was the premise of what we did was this was an entity that was below the line. And what Alan, I think I hear Alan saying, is we can just redefine them to be above the line. But it depends on how you think about that entity and all the other indicators, right, that we craft, example indicators. And I'm not tripping up any of those example indicators you crafted. However, you're asking me whether I think I'm going to be insolvent in 12 months. Yes. And so does that yes then mean, now that means I'm in severe financial stress, period, end? And now I've sort of I pushed them definitionally above the line, or whether we think that they remain below the line and give a different disclosure than the entities that are above the line or going to go into those other three cars, right? And I think that's an interesting, I don't know that there's one way to go about it. There's probably a couple of ways to do it, but I think it's an interesting thing to contemplate, right, as we're considering these next steps.
But you're not there as of that point. So even though we say we don't allow plans, right? We like actions, and we decided that in several projects, but we like actions. We're going to wait for the actions to take place. The same thing works to their benefit, right? They might have a plan as of issuance date, and when they project out, they look like they might be insolvent over the next 12 months, but maybe they enact that plan 2 months later, right? And then that mitigates it. So there's a high probability, but hey, we came up with some creative thinking and some creative ideas and did some other stuff. So I don't know that you consider them insolvent as of the issuance date because they're projecting out. And maybe I misunderstood what you said.
No. I think you did. What I'm just saying is that, because I think in your scenario, it could be the case, right? Like we're asking the government to make a judgment 12 months from the date of issuance, right? Are you going to be insolvent? Within that judgment, unless we put more words on the page about how you make that judgment, right? But in your world, Chris, you might say, well, what plans do I have to avoid that? And all of that will go into my determination of whether I think I'm going to be insolvent in 12 months. The question is, if I make that determination that I think I will be, or I'm at a probable, appropriate threshold level, then what disclosure do I give? Right? Because the disclosures we've crafted have been those disclosures about somebody being in SFS. And now you're not in SFS for the traditional, but you're now made this assessment you could be. And what Alan's saying, well, we could just change the indicators and say, hey, if you make this assessment that you're 12 months from insolvency, you're in SFS. And we define them above the line, right? That's one way we could do it. Or we could say, these guys are different enough that we don't want them making an SFS disclosure. We want them making a disclosure about something. I'm near insolvency. Here's why I'm near insolvency, right? So is it a different disclosure, the same disclosure? Are they in, right? That's the question.
I will say, to me, with the decisions we made earlier today, I'm a little bit where Alan is in that it's going to be really hard to have a second yellow car. The second yellow car existed more prominently if the SFS determination was as of year end, and then this probability assessment of insolvency, the look forward was available to be issued, and they're not the same date, they're not coming from the same date, then something could happen in that interim that caused me to become probable to be that close to insolvency, whereas as of year end, I wasn't. I was that second yellow car. But now that those periods are the same, okay, tell me then what we should be thinking about with this then.
So on page 11 of paper 1, we have the diagram. So, which represents what the board decided in March as to which cars or which governments will be required to make severe financial stress disclosures. And we didn't give all of the, axes and descriptions. We didn't repeat that in this paper. But the idea was you had this top line, which is being insolvent, and the red car is the only one that's over that. And then you have this next line, which was very poor financial condition, which what we called in the PV near insolvency. And we'll get to what we're going to call that going forward. And so the second yellow car is not in severe financial stress from whatever date you were looking forward. So it doesn't matter whether you were looking forward from the financial statement date or looking forward from issuance date or any other date in between. It was 12 months from whatever that date or whatever period of time. We're not to that yet, but within whatever period of time from whatever date, they're going to be insolvent, even though they are not in severe financial stress right now.
All I would say, I agree with what Trevor just said. What I was saying is I would undo that. And I'd go back to alternative 3 and say there is no second yellow car in my world. And you could get there. But I agree with what she just said based on what you decided. That's what you decided. That is what you decided last meeting. But now you've synced up these dates. It may be like, now we've synced up the dates. It doesn't make any sense. There'd be a second yellow car. I'm going to do this insolvency test before I do anything else. And if you fail the insolvency test, you're over the line, you're in severe financial stress. Go look at whatever other indicators you want to, but you've already decided you're over the line once you fail the insolvency test. But I agree, that would be alternative 3, which we didn't pick last time, which is inconsistent with alternative 4, which is in the paper. So I agree.
It would be a version of alternative 3.
I agree with what you just
said.
If the second yellow car doesn't exist, if the second yellow car exists, it exists at any date. If it doesn't exist, it never exists at any date.
I mean, it's an expansion of alternative. Alternative 3 didn't have that car. Right. And so alternative 4 has this car now, and Alan's saying, well, we can make the car go away. But we can't make its position go away, at least in the way we're talking about it, because they're not in, I mean, in the way we've thought about it, they're not in SFS versus the other car is, right? And so that could happen because something very quickly occurs or whatever, like however you're going to make that determination, right? But I think they are different than, 3 and 4, alternatives 3 and 4 are different.
I think I'm a little confused. In a world when we made the alternative 4 choice, technically the PV was still, SFS was determined as of year end, right? And so I could see, while I still don't think it's the majority, I could see, and GASB gave us examples of, I'm not in a poor financial condition at year end. And then in the 6 months or however long it takes me to get to available to be issued, something bad enough happens that if I do my forward-looking assessment from available to be issued, now I'm 12 months from insolvency. It's probable I'm 12 months from insolvency, but the real thing that caused that happened in those 6 months. That's why I wanted, when I voted for alternative 4, I didn't want to leave that car out. I didn't want to leave that entity where something so bad happened 3 months after year end, but before I issued it, I thought it should be included. In a world now where the assessment isn't as of year end, it's as of available to be issued, and the forward-looking assessment is as available to be issued. The only way I have this other second yellow car is if in my probability assessment looking forward, I have to predict something so bad is going to happen that I'm not in it now at available to be issued, but I'm still 12 months from insolvency. I don't see how we would ask anybody to predict that. And so I guess in a way, I would revert to alternative 3 at this point because of the decisions we made today, which I think were different circumstances than I was in or thought we were going to be in back when we made the choice for alternative 4 versus 3. I don't know if that makes any sense, but am I thinking about it right now?
A question, right? So if the issue is debt covenants or something like that, right? And we're talking about an issuance date on December 31st of the year. And whatever those covenants are, you have to meet them by May 1st. And you believe strongly that you're not going to meet them. You're not insolvent as of December 31st, right, at the issuance, but you think it's going to be tough for you to get there. So I'm just trying to understand the realm of possibilities that we're talking about here.
I would argue if you're in bad enough situation that based on what you know now, you think it's probable you're not going to meet those debt covenants 4 months later or something, you're in severe financial stress then. Like I don't have to predict something bad's going to happen that's going to cause me to not meet those debt covenant requirements.
What ultimately, and I didn't mean, I've already, okay. What it comes down to is if you sit there and if you sit there and do this as of issuance date and say, I've looked at the indicators in the PV and I've decided I'm in severe financial stress or not. Okay, that's one thing. If you look at a forward-looking assessment system 12 months from insolvency as of issuance, the question is, since those dates are the same, if I do an assessment that says I'm 12 months from insolvency, would you not then turn around and say, then you're in severe financial stress? And if you wouldn't, what condition would you say you're in? And to me, it's easier and just more simplistic and more easier to understand to say, look, if the forward-looking indicator, I'll call it a super indicator for lack of a better word, it's a binary indicator. It's a yes/no indicator. If you fail the 12 months to insolvency, in other words, you're 12 months from insolvency, then you are in the condition of severe financial stress, period, end of story. It's the only indicator we have where it's yes or no. If you're there, you're in. And if you're not, go look at all the other indicators and figure out if you have enough of those indicators to say you're there. But then to me, I'm determining where that yellow car is in relation to the line all at one time. And if that yellow car is either above the line because they're 12 months from insolvency, or that yellow car is above the line because of all these other indicators, I know where that yellow car is in relation to the line. There's only one yellow car for a government. That's how I'm thinking about it, especially now that the dates are the same date, especially now because of that.
Well, I think because of the same dates now, it has become that. Before I agreed there were two yellow cards.
You could, yes, based on how you described it.
So are we saying that the argument is that really under no circumstance, really in reality, are you ever going to not be in severe financial state stress or insolvent as of the date of issuance, but then based on your probability assessment, say you are, like that should never happen. Like that's off the board as something
Yeah,
that should
Involved.
No, I agree with you.
Okay.
That anytime you do the look forward as of the available to be issued date and you're probably you're 12 months from insolvency, you should just call that severe financial stress. I don't know how that isn't severe financial stress at the same date. And I get if the severe financial stress was assessed at a different date, like 6 months prior as of year end, okay, maybe something happened in that time period that could have made them different, which was to me, where we were back before, but now where we are, I don't know how you can't always be that.
So what, and maybe I'm getting caught up in my head and just need to think about it, but what value does the forward-looking assessment get us? Because if you're like, I thought the risk initially based on our old construct was you're not there right now, but there's a chance you might get there in the future, and that's important information to us. If we're basically saying there's no circumstance where you're not there right now, but your forward-looking assessment is gonna uncover that you will be there in the future, then that forward-looking assessment, probability assessment, really needs to be part of your basic assessment that you're performing. And it's an assessment as of that date that you're at or near. I know we're not at the at or near or nearly, but really that's the same thing, right?
I think I agree with what you just said. Based on where we are now, I think you still need to do the forward-looking assessment as a type of indicator or a explicit indicator of being in severe financial stress, but not the only one. You've got to look at these other things because that then helps us tie in with the audit literature because they want to do the forward-looking assessment. And the forward-looking assessment is to insolvency. So it's really to me, a cash flow assessment. And it should be something you think about in determining whether I'm in severe financial stress. And to me, if you've met it, it's probable then you are.
So me, Mr. Not wanting his food to touch, I understand now that my food touches. Those two are intertwined. They're linked, right? The mac and cheese are touching the sweet potatoes, and that's just going to be what it's going to be. And I'm actually going to like it because I like that, but that's
But I think he's right, though. It came back to, you can make an argument there were two different dates. When the SFS assessment was a current condition as of year end, and the forward-looking assessment was a forward-looking assessment as of issuance, you could argue, well, there's that time frame in the middle, maybe not the same, and therefore they're two different things. I'm just tending to kind of letting where Joel is once you put those things to be the same thing, it's hard for me to then say a government that thinks they're 12 months from insolvency wouldn't be considered government in severe financial stress. Like, to me, that just seems like it is. And to me, that's just a binary yes, no. And if you fail that, you are. If you don't, and then if you don't fail that and you're not 12 months from insolvency, you got to go look at all the other indicators that we've already set up and determine if all those indicators say that you still are in severe financial stress. It's just not because you're 12 months from insolvency. So it's almost, in my brain, it just becomes an indicator. It just becomes an indicator that's a yes, no indicator. And it's the only one of those we have because we've talked about a lot of the other indicators are just an examples of indicators. Well, this one's a yes, no. That's just the way, when you put the dates together, that's the way my brain thinks about it.
But it's yes, no based on the indicators, right?
It's yes, no based on that one indicator. All the rest of the indicators are just judgment and how big they are and how many you have.
But in order to get to insolvency, to make that decision, you have to look at the indicators.
To get to insolvency, I'm looking at cash flow. I'm probably not looking at most of those indicators. Most of those indicators, reducing service. Most of those indicators, I won't try to call them out because I'll call them out wrong if I try to do it on the fly. A lot of those indicators are not about cash flow.
There are ways to avoid insolvency.
Correct. So if you don't have them, but there's nothing in anything we've looked at so far that says you base your decision on cash flows.
I think we're saying the same thing, but it's basically when you're doing that forward-looking assessment, you're looking at your ability, those example indicators that are there, you're projecting out into the future the probability of tripping over one of them, right? And so it's one indicator, but it's kind of like you're thinking about several of them, maybe not all of them, a few of them. Right.
To me, I'm thinking about all the things that I am now at available to be issue. And I'm looking forward to, based on that and things I kind of know are coming up. I've got a debt service payment in 3 months, whatever the major cash flow. Am I going to not be able to, like, what's the definition of insolvency? Am I not going to be able to do that? Which is a cash flow. And if we need to describe that better and talking about the assessment, I think, I'm fine with doing that it's a kind of a cash flow look. To me, insolvency is inherently cash flow related, but
that's kind of what we based our indicators on too, right? Is that you have these because they're going to create issues with your cash flow, your inability to meet your obligations as they come due, those kinds of things, all are a reflection of cash flow issues. So to say that you don't look at those indicators when making your forward assessment, that's what your assessment of your cash flow is going to be based on, are those types of indicators.
It
I
seems
think you
to
guys are
me
saying the
that
same thing.
it seems to me that it's important to keep in mind too that there are governments that are going to be in SFS that never get to insolvency. And so you've got to keep those separate, that look at those indicators, but it may push them toward that 12-month. And getting back to your issue about the probability, you've got to factor that in, because that's that 12-month look forward. And that's going to say insolvency, where the others could just say, I'm in SFS.
Jackie, I think Diane, I think we're kind of saying the same thing. We're just not saying it the same way, because I do agree with you when you look forward and say, I've got to do I'm using the words we haven't decided yet, so sorry, forgive me about that. But if we're probable 12 months from insolvency, things like structural budget deficits, things like use of one-time funds, things like I know a debt service payment's coming up, things like I know I have structural operating losses in my proprietary funds, all that stuff's going to go into my assessment of where I'm probable. And yeah, those are all indicators on the indicator list. And so in that sense, yeah, you're not ignoring those other indicators, but you could get to an answer that says, no, I'm not 12 months from insolvency, right? And you still have some of those other indicators that still say, well, you're not 12 months from insolvency, but you're still in you're still in severe financial stress, even though you're not going to be insolvent in 12 months. So I do agree in the sense that a lot of those indicators will go into that thought process.
Can I just ask one other thing, Joel? Something that you said while you were talking before was this notion of, if I'm one of these governments, for now, we think is the fourth car as we exist now. And you said, well, now that we moved the date out to the issuance date, all these things that could have happened between the financial statement date and the issuance date will have already happened. Therefore, there's no predictions of things. But when we're asked, so if I'm a government and I had a giant legal judgment against me, and it happened during that period, by the issuance date, I've assessed it, right? I figured out what it is. I figure out what it does to me. But are you saying that as we ask that government at the issuance date to make this 12-month assessment, if they believe it is probable that I will get a legal judgment I can't afford to pay shortly after my issuance date, we would expect them to say yes, right? I talk to my lawyers, are we going to lose? Yep, it's likely we're going to lose. Is it probable that I'm going to be in, is it likely that this payment's going to be this? Yes, it's likely that payment's going to be that. I can't afford that payment, right? I would imagine there's nothing in we're writing that says the government can't take that into account in terms of making this determination, right? So we would still then consider that government to be in SFS because they're faced with that set of circumstances. I just want to make sure I'm thinking about it right.
I would say yes. I mean, if it's probable that I'm going to be insolvent within 12 months and that's the cause, and I'm comfortable enough including that, am I probable? and I know everything else that I have, and I'm not going to be able to pay that. And I don't, I would think I would factor into the probability, because in the real, what happens typically in those things, the judge isn't going to just, well, you're not going to be able to pay it, so I'm not going to make you. You're going to figure out a way to issue bonds to make the payment or whatever. I've got to think about all those things probably in my probability assessment about 12 months of insolvency. But I guess if you know them in that well enough to be able to say probable, then I would think you'd factor that in. But to me, that still tells me whether I'm in severe financial stress at available to be issued or not.
And not digging into the weeds, but digging into the weeds on that specific example. And you're sitting around a table that's a lot smaller than this one with attorneys from the government. They're not going to tell you it's probable. Like, there's no way with that on the line. There's no way they're going to say we don't have enough information to make that determination to that high level of probability at this time. So in that specific instance, getting away from government sovereignty and how on all of those other issues, there's no way they're not doing that.
I would agree with the practicality of what Chris just said too. Okay, we got on this because Jeff kind of asked a question. We were done with the paper, right? And then Jeff asked a question that I think was a good question. But to me, and maybe this is where Deborah's going a little bit, or you were going, do we change the TBD because of these things? Or do we want to bring that as a board question at a paper later? Or do we want to do it now? Or
Yeah, the TBD.
the TBD from last time,
right, not this.
that describes the three situations, or I don't remember exactly what they are, but the cars, describe the cars.
Yeah, perhaps my initial reaction is maybe the board shouldn't be voting on that without a full paper and analysis.
I think that's fair. That's fair.
Yeah, no, that's the right answer.
Well, that's what I thought we were going to say, but I wanted to check.
Yeah, I think kind of what were the two things that we're talking about, which then we can bring back. At the end of paper 3, we had the summary, which I know we haven't gone through the details of some of these yet. But the idea, that summary was governments required to make SFS disclosures should be governments that are, and then there are 3 things that could make them have to make those disclosures: that they are insolvent, that they are in a very poor financial condition or nearly insolvent, or whatever that is, or their likelihood of being insolvent within a certain time frame, which that disclosure, 3-piece disclosure requirement was based on the idea that there is this second yellow car that is not, it doesn't meet number 2. And so we added number 3 to make sure that they are included in the disclosure requirement.
And Deborah, fair to say you were eventually going to bring a paper back to the board to describe in more detail what that first yellow car would mean, what that second yellow car would mean.
We weren't planning on that.
But that's what we're talking about right now. I mean, that's kind of what we're talking about right now. That's what we're talking about right now. Is like we would need to do that and say, okay, given what we did last meeting, given what we just did now, we've got to talk about really whether there really are 1 or 2. And if there's 2, here's what the 2 mean. If there's 1, here's what the 1 means, given the decisions we made today, essentially.
Yes. I think the way that this could look, the way Alan was describing it, is the disclosure requirement would be 2-part. So governments would make SFS disclosures if they are insolvent or very poor financial condition, nearly insolvent, whatever that, when we get to paper 2, we'll figure that out. And then there would be an additional paragraph, sentence, whatever, then saying if it is likely that they will be insolvent within whatever time frame, they are in very poor financial condition. So it wouldn't be part of the, so it'd be a 2-part with then an explanation instead of a 3-part. So you can think about that in the next 6 weeks.
That sounds good, Deborah. Thank you. So we're done with that paper. Thank you, Jeff, for the additional conclusion. I think it's good. Do we want to take a break now and then do 2 and 3 after? It's 2:20, so. Okay, let's take a break and come back at like 2:40, like 15, 17-minute break-ish. See you at 2:40. All right, welcome back. Hope everybody had a good break. I see churros still around. Wow. Good progress so far on our going concern severe financial stress project. I'm calling Jeff out. Deborah, turn it back to you to start us off on paper 2.
Churros are worth getting called out for. So we will now turn to paper 2, which is about the details on the very poor financial condition part of the disclosure requirement. So as we were talking about before the break, as of right now, the disclosure requirement tentatively has 3 parts. In a government is insolvent, the details of that we discussed at the meeting last time. This very poor financial condition, which is paper 2, and then the forward-looking assessment, the details of which are in paper 3. So the preliminary views described this very poor financial condition as near insolvency, and further described that as being in close proximity to insolvency, and based on severity rather than a time to insolvency. And so some stakeholders who provided feedback to the PV agreed with that description. Others requested more guidance or a clearer description of what near insolvency means. Some of those stakeholders had specific suggestions for how to do that. So there are 3 topics that we will discuss in this paper. And the first topic to discuss is the need to take significant actions to avoid insolvency. So in the initial deliberations leading up to the PV, the board considered but rejected defining the very poor financial condition as some version of needing to take significant actions. The way it ended up in the preliminary views is those ended up in as one of the categories of example indicators that a government might be near insolvency. And so we had a stakeholder who responded to the PV who suggested that this should be part of the definition of a very poor financial condition. And so there are 3 ways that this idea of taking actions could be incorporated into the very poor financial condition. The first alternative, alternative 1, would be to define very poor financial condition as taking these actions. So that would be every government that needs to take actions would be by definition in very poor financial condition, and only those governments that need to take those actions would be in very poor financial condition. Alternative 2 would be sort of a one-way definition saying that if a government needs to take these actions, they are by definition in very poor financial condition, but other governments could also be in very poor financial condition even if they don't have that need to take actions. And then alternative 3 would be the preliminary views approach, where taking actions would remain as part of the example indicators that a government might be in very poor financial condition. So both alternatives 1 and 2 include a firm conclusion that some governments in this condition are by definition very poor financial condition, which might help some of the stakeholders who wanted more guidance and a little more certainty as to knowing whether a government is in this condition or not. But it would also remove some of the judgment involved which may or may not be a good thing, depending on how you look at it. Our task force members who weighed in on that were concerned about losing the judgment in this particular instance. So the project staff believes that it is better not to make a firm conclusion, so not alternatives 1 or 2. We continue to believe that no one indicator is a definitive sign, barring the conversation we just had. But we believe that this is not a definitive sign. How's that? And that we think it still should be a matter of judgment whether a government that needs to take these types of actions is in very poor financial condition or not. And so because of that, we are recommending alternative 3. So board question number 1 is, how should the need to take significant actions to avoid insolvency be included as part of the guidance? And the project staff recommends alternative 3, that it remains part of the example indicators.
Thanks, Deborah. Remember responses to question 1 here. Jackie.
I agreed with the staff recommendation. I would like to continue to support alternative 3. As you pointed out, our original intent was the actions in and of themselves wouldn't be the only thing that could indicate severe financial stress. And I think going the other direction just is too broad a way to approach it with alternative 2. So I believe alternative 3 is the correct decision.
Thanks, Jackie. Carolyn.
I agree with the staff recommendation. Alternative 3 has taking action as just one example of an indicator. Professional judgment is required and appropriate as government success if they are insolvent or very poor condition. So I still support alternative 3.
Thanks, Carolyn. Chris.
I echo Carolyn's comments, and I agree with the staff recommendation.
Thanks, Chris. Robert.
I agree with the staff recommendation as well. It's not as prescriptive, and it allows for appropriate use of judgment by a government.
Thanks, Robert. Diane.
I agree with staff recommendation and echo the comments that have previously been made.
Thanks, Diane. Jeff.
I do too. It's sort of like a Goldilocks thing, right? One option is to limiting, the other option is to restricting. I feel, and alternative 3 recognizes what I see as the reality that there's no single sign, although we'll talk about what 12 months of insolvency is, but I don't necessarily see it as a single sign in the way these other indicators are. But an assessment of a variety of indicators, which I think is the best way to come about to the decision. So I agree with the recommendation.
Thanks, Jeff. I agree with the staff recommendation as well. As my fellow board members have pointed out, and as a team in the paper and even the task force pointed out, we need to have room for professional judgment in making this overall determination. I agree we should, and we'll get to the indicators later, but I think the need to take certain actions should continue to be a part of the indicators, and we'll get to that later. But I do think as we're getting to that later, a lot of people seem to miss the need to in front of those, and which isn't exactly what we're talking about here. I would just note that and when we get to that part, to think about how we present the need to, because it didn't work exactly as we hoped it would, I think, the way we presented it in the PV, but that's a for later problem here. I agree.
Okay, thank you. So the next topic is governments that regularly operate near insolvency. So some stakeholders asked about governments that are in certain circumstances, perhaps even by design, they operate this way. Some examples are potentially a special purpose component unit that relies on its primary government to provide funding just in time to make its debt service payments. They don't keep much cash on hand. Or a town that issues tax anticipation notes every year due to the timing of the collection of their property taxes. So the bigger question is whether those governments should be required to make severe financial stress disclosures. The project staff believes that they should not automatically be considered in very poor financial condition. There were a couple of stakeholder suggestions to keep them out of the disclosure requirement. That would be requiring, as part of the disclosure requirement, requiring a progressive deterioration or acute stress rather than chronic stress. The concern with those suggestions is it might inadvertently exclude governments that are just stay in very poor financial condition. Perhaps those green cars that we've been trying to get into the disclosure requirement. In addition, the project staff believes that trying to define those circumstances would be very difficult. And so the project staff believes that the professional judgment should be involved in determining if a government is in very poor financial condition, that there is not necessarily, again, one specific thing that says that they are there. What might look like severe financial stress for one government might not be severe financial stress for another one. And so board question number 2 is, should governments that regularly operate close to insolvency always be considered in very poor financial condition? And the project staff recommends that they should not be.
Thanks, Deborah. Question 2, Diane.
I agree with staff recommendation. This would describe every school district in Colorado, and they would not be considered SFS. So I agree with staff recommendation.
Thanks, Diane. Robert?
I also agree with the staff recommendation. I think this would allow governments to evaluate the facts and circumstances. And if there's something changed on one of the, like, for example, one of the examples, the town that always is issuing a tax anticipation note and all of a sudden they can't, then they'd be probably making the disclosures in that instance. So.
Thanks, Robert. Chris?
I also agree with the recommendation. I think in the last response, someone mentioned professional judgment. I think that's even more important and resonates with the path forward to this question. And so a lot of it is just going to depend on the facts and circumstances, as Diane and Robert pointed out.
Thanks, Chris. Carolyn?
I agree with the staff recommendation. Each situation has to be assessed on its own merit. Requiring governments such as these to automatically make these disclosures could dilute the impact of the disclosures. So I agree with the staff recommendation.
Thanks, Carolyn. Jackie?
I also agreed with the staff recommendation. As has been pointed out, management judgment's really needed here. And it was never our intent that any one indicator be this is proof of severe financial stress. It was a more holistic approach that we intended management to take to look and see whether their situation qualified for severe financial stress. So yes, I agree with the staff recommendation based on what the reason we put the indicators in there in the first place.
Thanks, Jackie. Jeff?
Yeah, I agree too. I would avoid being prescriptive here. And, I agree that, the cases we deal with are idiosyncratic. And so to say in this instance, they're all in, or in that instance, they're all out, I think is not, not the way to go. I even think that some of the examples, whether it's the component unit or the TAN issuer, when I read the example indicators we had there, I didn't necessarily say, oh, well, they're obviously in. Right. I don't think it's that they're designed to work that way. And so I think that's right. So I don't think we're gonna have these close to or these governments that operate leanly gonna be thrown into these disclosures. I also would agree too that with the staff that, the idea, I think one of the commenters mentioned that, you always have to be deteriorating. And I think that's not necessarily the case, right? I think we want to capture those guys who, deterioration is the case for some of them, but for other of them, they may just be at a level and not really moving from there. And I don't think that necessarily makes them not a candidate for these disclosures, right? And we anticipated that in the PV where we talked about subsequent disclosures, and those subsequent disclosures would be updated so that if you're in this condition and year after year, you're going to have to update your disclosure as to what's going on. So it's not going to be a sort of static disclosure. So I agree with the recommendation.
Thanks, Jeff. I agree with the recommendation as well. Really, and Carolyn said it well. You'd hate to dilute these disclosures by including a whole bunch of governments that are designed to operate this way, and they're going to be fine moving forward, even though they kind of sit in this spot that's close to it. But you wouldn't want to exempt some of them either if the facts and circumstances warrant it. So I agree as my fellow board members have described.
All right, thank you. So the last topic for this paper is how to describe this very poor financial condition. So in the PV, we use the term near insolvency. Some stakeholders liked that and others did not. Some suggested using nearly insolvent, thinking that might help people understand that it's not about time as much. There was also a suggestion to define near. The project staff does not believe that there is a significant difference between near insolvency or nearly insolvent, but does think that nearly insolvent could be a little cleaner overall in the overall context of the disclosure requirement. The project staff also does not believe it is necessary to define near or nearly. Any definition would inherently still require judgment because we don't have those bright line metrics or ratios that could pinpoint what it means to be near. So question 3 is, how should very poor financial condition be described? The project staff recommends describing it as experiencing financial difficulties such that it is nearly insolvent.
Thanks, Deborah. Diane.
I agree with staff, and as Deborah just said, it's cleaner to say nearly insolvent. It also avoids the at the point of insolvency when the government is just actually insolvent, and so I think that part's cleaner too.
Thanks, Diane. Jackie.
I support staff recommendation too. I like nearly insolvent. I think it's a little clearer on what our intent is with that. I don't believe we should define nearly or near. I think that's a management judgment situation that needs to be done. When we started going down this path, we realized it would probably require guidance at some point on implementation. And I think we're still there, but I don't think we go to defining nearly to provide that guidance.
Thanks, Jackie. Carolyn.
I agree with the staff's proposed description for very poor financial condition. Am I the right question? Yeah. Okay.
Thanks, Carolyn. Chris.
I also support the updated terminology and agree with the staff recommendation.
Thanks, Chris. Robert.
I agree with the staff recommendation.
Thanks, Robert. Jeff.
So when I originally read this, my question was, because we seem to be focusing obviously on the firm that we got questions on, the nearly insolvent. And I said, well, where's insolvent? And I saw in your in the summary in paper 3, right, you describe those who make the SFS disclosures, as you pointed out, was 1, those who are insolvent, those who are in effect nearly insolvent, as we describe here. So just in terms of thinking about it, though, the very poor financial condition, were we to call that SFS and make it SF, really in truth includes those who are insolvent, right? So it's insolvent plus these guys who are nearly insolvent, right? As we point out and because I saw it in 3, I'm like, okay, yeah, we're sort of handling this near insolvency question here, just to make that clear. And I talked a little bit to Deborah too. We changed financial stress to financial difficulties, right? And I think in part to sort of capture maybe some people are having trouble interpreting what we mean. And I sort of feel like, okay, difficulties is sort of, I think, a fine enough substitute for stress, right? So especially if we call it severe financial stress is stress, like, so we'll avoid that by going with difficulties. So I was okay with that.
Thanks, Jeff. I agree with the staff recommendation as well. I think, Deborah, you said it really well in the lead up to the question, and I agree with all those points. And I do like nearly insolvent to be a little more clear than near insolvency, although they're pretty close to the same. It does sound a little better.
All right. Thank you. That concludes paper 2. Then we'll move on to paper 3, which is the details of the forward-looking assessment. So as we noted, this was not in the PV proposals, so we have no stakeholder feedback on these. It's just being considered for the first time. And we had a little allusion to this earlier, but the first topic to talk about is consideration of a government's plans. And should they be included in the assessment of the likelihood? Plans that a government might have might affect the ultimate outcome of whether they become insolvent or not. But plans have also not happened yet, as opposed to actions which have already taken place. One reason why this is being raised here is because of the FASB's going concern guidance, which is a forward-looking assessment to insolvency, the same type of thing that we are considering here. And in their guidance, entities first assess, do their likelihood assessment without considering plans. And then if it is likely, then they do a second assessment if those the plans alleviate the doubt of becoming insolvent. And then they have a different set of disclosure requirements depending on which one it falls into. So there are 3 potential scenarios that a government could find themselves in. The first one is that they meet the likelihood assessment with or without plans. Either way, the answer is the same. The second one is they do the assessment without considering plans and they meet it, but then if you were to add the plans to the mix, they would not. And then the third one, they don't meet it either way, with or without the plans. And so the project staff believes that users would want severe financial stress disclosures for governments that meet the likelihood without plans, because that in part indicates that past actions have not been sufficiently effective to bring that likelihood down. Some of our task force members expressed concern about making severe financial stress disclosures, even though the plans make it unlikely that a government will actually become insolvent. However, another task force member advocated for consistency with Statement 102, which required actions to be considered, but not plans. The secondary issue is if plans are not considered in the assessment to begin with, whether there should be a second step to evaluate the likelihood with plans, which would trigger a different disclosure requirement similar to what the FASB does. The different disclosures, though, would be about the plans, either a statement that the plans would bring that likelihood down, or here's what the plans are, or something like that. The project staff does not believe that those are pieces of information that would be appropriate for note disclosures under Concept Statement 7. And so the project staff believes there's not a reason to make a secondary consideration. So question 1, should the likelihood assessment include consideration of a government's plans? And the project staff recommends that the likelihood assessment should not include consideration of plans.
Thanks, Deborah. Board member responses. Chris.
I'm sorry. The way you turned around like that it was like a quick.
Diane
It was just like you
pointed.
whipped
Diane
around.
pointed. I'm like, I
Oh,
got
it was-
somebody.
I never saw you whip around that fast before in all my years. So I agree with the staff recommendation. And that consistency with 102, and we talked a lot about it at the time, and the importance of actions over plans is really important here as well. So that said, I agree for all the same reasons that I supported it with 102.
Thanks, Chris. Carolyn.
Move us fast on mine.
I was already looking that way.
Okay. No, I agree with the staff recommendation. Basically the same reasons that Chris said, that we've had a really robust conversation about plans versus action in 102, and I still believe that it should be based on actions and not plans.
Thanks, Carolyn. Jackie.
I agree with the staff recommendation for the reasons my colleagues said. Probably actions are even more important here than they are in 102, given what we're talking about here. So yes, I definitely think actions trump plans.
Thanks, Jackie. Robert.
I agree with the staff recommendation, Jackie, Carolyn, Chris. We'll see if others do.
Thanks, Robert. Diane.
I agree with staff recommendation. And in my mind, if a government has not taken any kind of action to start implementing their plans when they're that close to insolvency, then something's wrong. So I agree.
Thanks, Diane.
Yeah, this is just Q1, right? For now. Yeah. So this to me is tantamount to FASB's initial assessment, right? Like you assess your likelihood without consideration of plans. And I agree with that.
Thanks, Jeff. I agree with the staff recommendation as well. As you point out in the paper, governments often have many different types of actions that they can take to avoid insolvency, and we've talked about that throughout this project. And even when those then plans for those actions are out there, they might choose a different alternative. I think the government, as they make plans, because they have so many different things they can do and levers to pull and people involved in these kinds of decisions, I just think the likelihood always of those plans actually coming to fruition is maybe even lower than it would be in the private sector. And the information that would result from accounting for those plans, to me, and I'm foreshadowing question 2 as well, I just don't think is all that reliable of an information in our world, and would jeopardize then the disclosures being as effective as they can be. I also agree with why we did that, kind of using that same logic in 102, and the kind of symmetry and same thought process being used here makes sense to me as well.
All right, so then question 2. So if the likelihood threshold is met without consideration of a government's plans, should the government then also assess whether the likelihood threshold is met with consideration of its plans? And we recommend that it should not.
Thanks, Deborah. Jackie.
I agree with the staff recommendation on this one also. I don't necessarily see the value of including the plans at this point. Again, they're plans, they're not actions. We don't know that they're going to happen. They could change them numerous times. If their plans are such that that's not going to change the situation or the consideration anyway, I'm not sure that those plans are that valuable to the decision process, other than the fact that they're going to have to go back to the drawing board. So no, I don't think we should have to consider it.
Thanks, Jackie. Carolyn.
And I also agree with the staff recommendation.
Thanks, Carolyn. Jeff.
So if I'm thinking about this correctly, I sort of see a couple of wrinkles here. So we have the initial assessment done without considering plans. You think you're in it. Now, as I think about it some more, should the government then also assess whether the likelihood threshold is met with consideration of plans? Now, I think in the FASB world, you would, even if you think you are going to prevent that, you would still disclose the it and then disclose what the plans are. In other words, you don't now get a get out of jail free card, right? And say, oh, well, now that I consider my plans, I don't have to make the disclosure. So that being the case, I do think, and maybe I'm going to be a bit contrarian here, I do think there's would be a case where there would be a lot of users interested in what those plans are. Because obviously there's something really important here, trying to figure out what you're going to do to mitigate it. The fact that you still have to make the disclosure that, you know, this situation exists, here's what I intend to do about it. Now I understand the ground I'm trotting closely to 102, right? Like, hey, Jeff, you're being inconsistent with 102. I do think there's a little bit of a difference because in 102, you were talking about, I think what the government was assessing was substantial impact, right? And substantial impact, as I look at concept statement 7, you know, effect of future events on future financial position, that's future financial position, substantial impact. This is, am I going to be insolvent? Is that future financial position? Does that relate to future financial position? That's not quite so clear to me. Right? It obviously has a financial aspect to it, but am I asking you to predict future finance? No, I'm not asking you to predict future. I'm just asking, are you going to go insolvent or not? Which, if anything, is more of a legal matter than a financial matter, right? I failed to pay under my obligations, right? So in that sense, I could get sort of behind the notion where you could, you know, make the assessment. If you meet, you make the assessment. If you really think you got plans, you describe the plans, because I don't think that necessarily trips us out of CS7 because of the nature of what's going on here. But I may be in the minority view on that.
Thanks, Jeff. Chris?
So I agreed with the staff recommendation. I wonder, Jeff, to your very point, what the concept statement, if it falls out, right? Because it really is only planned. So how, you know, essential is that? But then also you have other mechanisms, right? I think Robert talked about before, there are other ways that you can convey information to users of financial statements. You got a transmittal letter right there. If you really want to dive in deep on your plans and it's not governed by us saying, this is what you have to do, this is the structure, that's the perfect vehicle to throw those, hey, this is what we're doing, this is what we plan to do, throw it in there. And then you don't muck up our financial, you don't muck up the financials with additional information that may or may not happen and really doesn't add any value in and of itself until the action is taken. So those are my 2 cents.
Thanks, Chris. Robert?
I agree with the staff recommendation, recognizing Jeff's point about maybe is insolvency more of a legal than a financial issue. And we're talking about financial statements. I'm not totally sold that the concern the staff brought up with concept statement 7 is not valid, because it may ultimately result in some, you know, you're predicting, you know, some future financial position. That financial position may be insolvent, but it's potentially. So I supported the staff recommendation.
Thanks, Robert. Diane?
I agree with staff recommendation. And as mentioned before about the Con 7, I would have concerns about it being predictive, and I think that's a problem.
Thanks, Diane. So I agree with the staff recommendation. I'm not as persuaded, Jeff, though, that it's the Con 7 part of it as much as I talked about earlier. I just think governments often have things that they plan to do. And, you know, to use Chris's term, I don't want to muck up the disclosure and start adding a bunch of things that may or may not happen. And you know, one of our objectives of financial reporting is reliability. And, you know, how reliable is that information? And I just worry about having seen enough, like to Diane's point on the last question, a government should be doing things about, if you're in this bad of financial shape, you should be doing things, not just coming up with some plans that haven't started to mitigate or whatever. And so I just worry that it's almost information that would take away from the disclosure more than help the disclosure, is why I would like for it to not be in there, as opposed to whether or not it is predictive or doesn't meet Con 7 for that purpose. So you didn't get anybody in with you, Jeff? Be in your
I'm
no
not
bucket.
altogether upset with the outcome, as I indicated to Deborah. So, I mean, I think I'm looking at it glass half full as it relates to the plan.
like
While
that.
everybody else is looking at it glass half empty, but you know,
I don't like that.
I'll take my no bucket and be quiet.
Gotcha. Sounds good.
Okay, so the next section is the level of likelihood that has to be reached in order to trigger the disclosure requirement. So the project staff considered 4 thresholds that already exist in other GASB standards, plus the potential to create a new likelihood threshold. There are interpretation challenges inherent with most of the existing terms, other than more likely than not, because they do not have precise definitions as they exist in the other guidance, and could be interpreted differently by different stakeholders. The project staff believes that a new term would further complicate the landscape of likelihood thresholds that we already have with the multiple options. None of our task force members were in support of adding a new term. Of the 4 that we considered, we believe that reasonably possible is too low of a threshold and reasonably certain is too high. That leaves us with more likely than not and probable in the middle. Our task force members who weighed in expressed a preference for either of those 2 terms. The threshold of more likely than not, although it is precisely defined in our literature, may not be high enough for the purpose of this disclosure, as the likelihood could be almost equal that they will or will not be insolvent. Many people think of probable as being a higher threshold than more likely than not, although there's no authoritative guidance that says that is true. So recognizing that there might be some diversity in practice in using probable as a threshold, some governments might make the disclosures at a lower level of likelihood than maybe the board wants. Other governments might not make the disclosures if they think of probable as higher than the board thinks it is. But despite that, the project staff still believes that probable is the best option. So question 3 is, which likelihood term should be used to describe the level of likelihood that a government will be insolvent within a certain time frame? The options being reasonably possible, more likely than not, probable, reasonably certain, or a new term. And we recommend option 3 being probable.
Thanks, Deborah. Question 3, board member responses. Diane.
I agree with staff recommendation, and even though there may not be a great solid definition for probable, I think there's a lot of judgment involved anyway. It's just a higher threshold, and I think that's important. Also, FASB uses probable in its assessment of going concerns, so it's a familiar term to users in assessing this type of thing.
Thanks, Diane. Jackie.
I also agreed with the term probable. The only other one I would consider is the more likely than not, but I think that might be a little too broad and might capture a little too many entities. So I support probable, and we use probable a lot in the literature. So it's not precise, but technically neither is more likely than not. So I'm fine with probable.
Thanks, Jackie. Carolyn.
Oh, I was torn between probable and reasonably certain, but I landed where I believe the staff landed as far as reasonably certain being just too high. So with that kind of being eliminated, I do agree with the staff recommendation as far as probable.
Thanks, Carolyn. Chris?
Yeah, similar to Carolyn, I started by looking at the top of the scale, because the bottom was just going to capture too much. And yeah, reasonably certain. It just felt like if you are in that top echelon, then like you probably didn't need a assessment, or it was pretty easy to get there, right? Because if so that's why probable made a lot more sense. And look, if someone's kicking the tires on the estimate and having a hard time getting there, then then you're not, right? At least in that forward-looking assessment. So it made a lot of sense to me. I think the 1 year forward with the probable based on the assessment date all kind of marries together to get me comfortable with it.
Thanks, Chris. He threw in a 1 year. He's already jumping ahead to the next question.
Next question. Just dump questions.
Robert?
I also agree with staff recommendation for some of the sentiments already expressed. I reasonably certain I think you wouldn't catch certain governments that probably these disclosures should be made. More likely than not, you'd probably snare some that I don't believe should be, and I think that's a lot more nebulous, even though probable doesn't have an explicit definition. But I support the recommendation.
Thanks, Robert. Jeff?
So I unsurprisingly kind of swung at it from the other direction, right? And I think it was mentioned in the paper, right? That first of all, as we said before, not a whole lot of governments are going to have to mull over this decision, right? It's going to be a small fraction of governments. So if there were even a slight chance that you thought you were going to be insolvent in a year, I think there's a lot of users that would want to know about that. That being said, I swung over to, well, I got to be consistent, right? And so if I got to be consistent, then I thought about the more likely than not versus the probable. And as some of my fellow board members said, in this particular context of insolvency, right, the term of art seems to be probable, right? FASB uses it. We used it in 56. We used it in the PV as it relates to PD, right? So I'm like, okay, I think I'll settle on probable here, while acknowledging that, there would be those who would be interested in an even lower threshold.
Thanks, Jeff. I agree with the recommendation as well. I think it finds the right balance. I think if you were to use reasonably certain, essentially you have to know that the governments are going to go to, I have to almost basically know I'm insolvent. And so that seems too high for this important disclosure. And more likely than not, to me, is too low, because I mean, it's probable is at least above more likely than not. Where and how far above is where the judgment lies. But a government that's 51% probable, or 51% not probable, 51% likely to be insolvent in 12 months versus the government that's 49, you're not going to really ever get that precise, right? Because there is it's all judgment, but just the notion of it to me doesn't sound like the right place to be. So probable seems like the right place to be, including and inclusive of the consistency with FASB. And I guess 56 really doesn't use a likelihood at all. It says substantial doubt, which substantial doubt doesn't sound like more likely than not to me. It sounds like something higher, but again, it's a different concept, I understand. So this feels consistent with what other people do in this realm. So that adds to me saying that this makes sense.
All right, thank you. So that brings us to the final section of the paper, which is the duration of the look forward period, or how far to look forward. So there are options that including a bright line time frame, such as 6 months, 12 months, 18 months, an unspecified period, such as in the near future, there's the word near again that we're not going to define, or a bright line plus some unspecified time frame, such as 12 months or shortly thereafter, as was done in Statement 56. So a bright line assures that governments are all looking for the same period of time. Although that could mean if a government thinks they're going to be insolvent, but not until just after that time frame, they would not be captured in the disclosure requirement. The longer the period goes out, the harder it is to reach a higher level of certainty about it. Given all of those factors, the project staff recommends a bright line period of 12 months, being that is a typical cycle for governments, and the benefit of having the same clear cutoff time frame for everybody, we believe outweighs potentially excluding some. The task force members who provided feedback on this were supportive of that recommendation. So question 4 is, what should the duration of the look forward period be? And we recommend that it be 12 months.
Thanks, Deborah. Board member responses to question 4. Jackie.
So I agree with a bright line. I'm not a big fan of bright lines in general, but I think in this instance it works. I don't like the term "or shortly thereafter." That's just too vague. Yeah, you can game a bright line, but you can game shortly thereafter too. If management's really into gaming, they'll find a way to game. So I don't think that that should be the factor that causes us to make a decision. If I were going to be consistent with what I was thinking in paper 1, I'd say that the look forward period should be 1 month. But based on the fact that we're looking for some kind of something that users can be comfortable with, I'm going to support the 12-month time period.
Chris.
So Jackie, I completely appreciate and understand where you were coming from, because I struggled with this too, just in general, just the forward looking, and the way I got comfortable over the time period, along with the probability is everything and everything else is just that, like, you're making an assessment based on all the information that you have, right? And so while I can say 1 month out, I might feel fairly certain, the further out, maybe I have less evidence to support it. Well, then by design, you're automatically out if there's not enough evidence there, if you can't gather enough support to get you to that high level of probability. And the further out you go, the harder it is to gather enough evidence to support it by design, right? That's just how it works, because you're you're farther away from those facts and circumstances that exist at that point. So that all said, that's why I'm comfortable with 12 months, because it's kind of like, yeah, but maybe I would be more comfortable with 6 months or something less, but the further out you go, you still have to prove to that standard, and that's tougher to do. And, and so that involves even more information, and it might not be information that you could really get at the time. So the burden and the getting it wrong and all of that other stuff, I just think it plays itself out, and it's not even an issue.
Thanks, Chris. Carolyn.
I agree with the staff recommendation that 12-month period was appropriate. And I really didn't have a big issue with the bright line. I like the fact that all the governments will be using the same, the same period, not the 12 months or close to it, or any other type of, I don't know, unclear language. So I agree with the staff recommendation.
Thanks, Carolyn. Diane.
I agree with staff recommendation. And so statement 56 required that 12 months, but it was kind of like with that additional, and it was kind of squishy, and it was from the date of the financial statements. Well, since we're starting this look forward from the date that the statements are available to be issued, we're going out a little ways. We don't need that extra. So I really like the 12-month hard stop. That's it.
Thanks, Diane. Robert?
I support the staff recommendation. The one aspect of it, even though I kind of like Jackie's 1 month thing, I think, as was pointed out, a shorter look forward period might not capture those. And, you know, the trains left the station on the date when the assessment's made. And I think the bright line period is appropriate.
Thanks, Robert. Jeff?
Yes, I too, like Diane, focused on the interplay between the date the assessment is made and how long the period needs to be. So you guys are all grateful that you decided on the issuance date. Therefore, you don't have to listen to me sort of start to argue for an 18-month period, because that's what I would have done if we had just said, hey, we're doing it from the financial statement date. And I'll say, yeah, we're 9 months out. Give me some information. And then you would have heard me advocate for that. But now you don't. So I agree with the recommendation.
I don't know how to follow that one. I agree with the staff recommendation. I agree with the bright line. We kind of discussed this a lot in statement 102, and it kind of goes the whole this whole assessment isn't an exact science. So are you going to be insolvent in 12 months and 2 days, but you're not in 11 months and 28 days? Nobody's going to know that exact date. So giving them an exact date to kind of at least try to make an assessment to, I think, makes more sense than having that be squishy too, when everything here is already about judgment. And I do believe that governments, especially those with liquidity problems, are going to have cash flow information, or should have cash flow information enough to look out 12 months to see if they're going to be solvent or not. So I agree with the recommendation.
All right, well, that concludes paper 3, which is the last paper that we had for this month. Looking ahead, our plan for June was to bring back redeliberations on the example indicators. We'll also look at the thing we talked about earlier. I think we can still manage to do both.
Excellent. Thank you. Appreciate you doing that. A lot of good stuff in these papers. Thanks to you, Deborah, and the team for putting them all together. And we look forward to next time. With that, we're going to adjourn for the day. And our last remaining kind of overall topic for the board meeting is the technical plan update. But we do have a number of papers related to that, but we'll start them at 8:30 a.m. tomorrow morning. See everybody then. Have a good evening.